yes, a bunch of stuff we discussed everything. So now suggestion is, some of the students, what they've asked is, let us have a look at initially the option valuation basics. They know, a lot of you know already what is call, what is put, but instead of getting into what is call and what is put, let us get into valuation, where we talk about risk neutral valuation and binomial valuation. And especially in the immediately previous exam, there was an issue of, some question that was asked, which was slightly twisted. And Institute also, I don't think, did a fair job there by asking a question for which they themselves gave a wrong answer, in my opinion. But anyway, I'll tell you what the Institute did and all that. So keeping that part aside, let us actually look at the core of how options are valued, and then we'll move on from there. So these are all the aspects that we discussed about already. So let me move directly to option valuation to start off this particular today's session, right? Option valuation, there are three methods: binomial, then risk neutral, and Black-Scholes. And as per the CA Institute, binomial has a binomial tree, but then you don't compute using the probability. Probability apparently comes within only in risk neutral method. Anyway, no problem. Let us agree with what they say. And in binomial, they're saying there's one thing called delta shares plus portfolio replication. According to them, these two are binomial method, and a risk neutral method is where you find out the probability and use that to discount the various payoffs, right? Just hold on for 1 second. Yeah, I was just checking something, that's all, nothing else. Okay. Yeah, so Institute is hung up on this aspect about delta shares and portfolio replication being part of binomial, and risk neutral is using P. So we will get into both the aspects. I'd like to spend some time explaining these in this particular session because that seems to be the flavor of the season, right? So anyway, so coming first to that aspect, right? So I wanted to first take you through what is this P. P we have as probability, which is e power RT minus D by U minus D. So in if you draw a binomial tree, and let's say today the stock price is 60, and this e power RT can also be 1 plus R. Right. It depends on what kind of information that is provided, because sometimes they give you continuous compounding, sometimes they give you normal compounding. Sorry, excuse me. Right. So if you look at the continuous compounding, you use e power RT, and if you do normal compounding, you do 1 plus R. Right. Now, if you look at, assume that, spot is 60. Let us take an example, and we'll continue with this example all throughout. Strike price is 65. Upward movement, that the stock has only two ways in which it can move, upward or downwards. Upward, it can move up to 66, and downwards, it can move up to 54. So up is 66, down is 54. Right. Then I will take R as 5%, and instead of using e power RT, we'll use 1 plus R. 1 plus R equal to 1.05 because it makes life simpler. If e power RT will also be equal to 1.05 or something very, very close. Okay. So that is just a semantic. Depending on the information that is given in the question, you can choose. You have to decide whether you want to follow this or you want to follow this. But e power RT also for 1 year, and period time is equal to 1 year. And option is buy call. Okay, buy option is call option. Okay, and your buying a call. Now, if you look at this, the stock can grow up to 66 or go down to 54. So that is, it can increase to 1.1 or it can fall down to 90% of 60. 16 to 90% is 54. 16 to 1.1 is 66. That is 1.1 or 0.9. So basically, this is 1.1. This is 0.9. SU, SD, and UD. Okay. So SU is 66, SD is 54, U is 1.1, and D is 0.9. Now, if the stock can move only in two directions, and this is a perfect world in which there is it is risk neutral as well. Risk neutral. What does the word risk neutral actually mean? Risk neutral means basically in this world, you don't care what you don't have this risk versus return. Excuse me, having slight cold. In this world, you don't have a risk versus return logic. That is, just because risk is increasing, you'll want a higher return. Irrespective of the risk, you will want same return. Right. So that's a risk neutral world. It is not a world where everything is risk free. Okay. It is a world where you you're neutral to risk. Even whether risk is high or risk is low, you want the same return. Right. Now, if this is a risk neutral world, then you are perfectly okay with the stock going to 1.1 or 0.9. Now, in this case, what is the payoff of a buy call? Payoff of a buy call is maximum of 0, your spot on T date minus your strike price. Right. So on the due date, if the option is 66 rupee, if the stock is 66 rupees, what is the payoff of the option? Payoff is 0, 66 minus 65. Why 66 minus 65? On that date, the spot is 66. 65 is the strike price that you have agreed. So 66 minus 65, this is 1. And payoff is 0, 54 minus max of. Okay, please note max of 0, 54 minus 65. So 64 minus 55 is minus 9. Max of 0, minus 9 is 0. So the payoff is 1 in first case and 0 in second case. So the option is having two payoffs. Right. Now, if option is having two payoffs and an option to what? Option to buy a call after 1 year at 65 rupees. The option is having a payoff when the spot is 66 or 54. The payoffs are 1 and 0. Now, what you do is, if this were a risk neutral one, if it were a perfect market, sort of a market where everything is priced properly, everything is, almost everything is priced to perfection, right? Then what happens is, same asset will have same price irrespective of the instrument. That is, underlying asset will have same price. So this is an option on a stock whose spot is 60. What is the futures price? Future or forward, what is the price? Is S into e power RT, not minus RT, e power RT, or S into 1 plus cost of carry, right? Whatever the cost of carry is. So it is 60 into 1 plus 5%. Right, why 5%? I'm using simple compounding, as I said. I'm not going to use E power RT. So 1 plus 5 is 1.05, 16 to 1.05. So futures or forward price after 1 year is 63 rupees. Right. Now, if you have a stock that is today 60, can go up to 66 at one, gain by 10%, or go down to 54, gain by, reduce by 10%. These are two probabilities that exist. So, and there are only two probabilities. I assume there are only two probabilities. Futures or forward price is priced at 63, whereas if you are looking at it in option terms, the price can either go up, and these both have different probabilities. Why do they have different probabilities? Because there is, the stock as per the futures and forward, the price is at 63. Now, what is the probabilities? We will figure out. If there is a probability that 66, and let's say the upward probability is P, then the downward probability is 1 minus P. Why? Because there are only two probabilities. If one is A, other one is 1 minus A. So this 66 can go, has a probability of P to go to 60. The 60, I'm sorry, the 60 has a probability of P to go to 66, and it has a probability of 1 minus P to go to 54. Now, this stock, how is it valued in future? Future value of the stock is, we already arrived at it as 63 as per futures, right? Whereas as per options, when you're trying to check through options, it can either be 66 or can be 54, but the expected value should be 63. Why? Because the stock, already the expected value of a future, as per a future contract, we've already arrived at 63, no? We are saying there is a stock, you're looking at it in two different instruments. One is a futures or forward, other one is an option. As per futures or forward, the expected value of the stock is 63. You go by the underlying logic of options, there also the expected value should be 63 only. So 66, which is the up move, into P plus 54 into 1 minus P. This is probability of up move. This is probability of down move. Should be equal to 63. Why? The asset should have the expected value here and expected value here. Both are same because underlying asset is same. An asset cannot have two different expected values in the future. So these are, you are equating both of them. When you equate both of them, what will happen? 66P plus 54 minus 54P is equal to 63. So 66P minus 54P is what? 12P is equal to 63 minus 54, or 12P is equal to 9, right? 12P is equal to 9. So P is equal to 9 by 12, which is 3 by 4, which is 75%. So if the probabilities are arrived at in such a way that the expected value of the stock after 1 year, as per a normal futures or forward formula, is the same as expected value of the stock as per the options to up move and downward, whatever we have arrived at, as per the way you're working on options, the expected value of a stock as per options working, expected value of a stock as per futures working, both have to be same. We are equating both, and we are arriving at a probability called 75%. Now, if you put this into equation, what equation will be? You see, what is 66? 66, we've already denominated it as 66 as S0 into 1.1 or S0 into U, right? So, or S66 is, yeah, S0 into U. So, S0 into U is 66. S0 into D is 54. This is S0 into 1 plus R. So on both sides, you have S0. S0 is here. You can take S0 here, S0 here. So on both sides, you have S0. So you can cancel S0, right? Right. So what is S0 into U is 66. S0 into D is 54. Why? What is S0 into D? S0, 60 into D is 0.9. 60 into 1.1 is 66. So you take S0, you replace the 66 with S0 into U, 54 with S0 into D, and you replace 63 is S0 into 1 plus R. Now, S0 take common, eliminate on both sides. And what you'll have is U into P plus D into 1 minus P is equal to 1 plus R. Now you take PU plus D minus PD is equal to 1 plus R, or P into U minus D plus D is equal to 1 plus R, or P into U minus D is equal to 1 plus R minus D. P is equal to 1 plus R minus D by U minus D. So, which is same as e power RT minus D by U minus D. Okay, if you take normal compounding, it will be 1 plus R. If it is, you take daily or continuous compounding, you'll get e power RT. So this is how this formula of P is arrived at. Basically, you're taking equivalence, like your equivalence of expected values under futures, under basically options working. On both of them, expected values will be same. Both of them expected values will be same. Then the probability at which the stock price has to move up or down is arrived at using this formula. All right, this is the first aspect. This is relevant for you to understand. I mean, they've just given the formula in the study material. I want to explain you guys how by this formula or how this formula has been arrived at. Next question is, what did we discuss here? I said first we'll arrive at P. Okay, this is risk neutral valuation, how we arrive at P. Now, what is binomial valuation? Once you arrive at P, then option, it is very simple. How to value the option? Let us complete that aspect also. Okay, let us complete that aspect. So P is e power RT 1.05 or 1 plus R is 1.05 minus 0.9 by 1.1 minus 0.9, which is 0.15 by 2, which is by 0.2, which is 3 by 4, which is 75%, which is what we got here, right? 75%. Now that you've got 75%, the 60 can go up to 66 or go up to 54. Probability of this is 75%. Probability of this is 25%. The payoff here is 1. The payoff here is 0. Then how do you arrive at using risk neutral valuation? How do you arrive at the value of the option? So there is an option expected payoff is what? Is equal to option payoff into probability. Sigma of this, basically sigma of this. So that is 75% into 1 plus 0 plus 25. 25% into 0. 25% into 0 plus 75% into 1 is the expected value of option payoff. That is 0.75 is the future value of option or option payoff. Option payoff and future value of option both are same. Because why will you, if I'm going to get something, if I'm going to invest something at 10 rupees today and get 12 rupees tomorrow, in a perfect world, I'm making a gain of 2 rupees. So that asset you will be valued at present value of 12. If I put 10 rupees today and I'm getting 12 rupees tomorrow, basically I'm getting 20% return. If I have to sell it in the market, I will sell it assuming the 20% return. I will sell it at present value of the 12 rupees. Okay, same logic. The future value of the option is basically the payoff of the option, right? So what is the present value of option? Present value of option is 0.75 divided by 1 plus R, or you can do e power RT. So this is 0.75 divided by 1.05. You will get it as 0.71428. 0.7142857. So I will round it off to 0.7143. Okay, I will round off to 0.743. So using risk neutral valuation, the value of an option or the price of an option with what features? Call. Strike price, spot is 60, strike price is 65. It can go up to 66, come down to 54. Interest rate is 5%, time is 1 year, and the probabilities that we work backwards and arrive at are 75% and 25%. Then the expected payoff of the option is 0.75, and the present value of the option is 0.7143. Okay, so this is the key element that you have to understand. This is basically what is risk neutral valuation as per our institute. This is how they have evaluated the latest answer sheets, and this is what they've given in the suggested answer. Okay, now this is the first aspect. Now let us come to second aspect. What is second aspect? After having understood about present risk neutral method, let us go to binomial. Even in binomial, we'll take the same example and we'll take the same tree. This is called as a binomial tree. It can go up to 66 or come down to 54. In this, what basically happens is you use a principle of replicating portfolio. You use a replicating portfolio. Or hedge using delta shares. So these are two aspects, two independent aspects. Right now, you can both of them will give the same result. Both of them are very closely linked, but both of them are different ways of looking at it. I won't say they both are independent. They both are different ways. One is looking from this side, other one is looking from this side. Okay. Now, first, let us understand what is this whole replicating portfolio strategy. Before we understand replicating portfolio strategy, let me just, add a couple of more points here. Here, the payoff is 1 and here the payoff is 0. Why? You saw this, no? If strike price is 65, so the stock price goes to 66, you make 1 rupee. And if stock price goes to 54, you make 0 rupees because it's a call option. Right. Now you find out something called as in a replicating portfolio, you find out, you create some X number of shares and you sell delta, you sell a call. Okay, sorry. You sell a call. Right. So what you're basically doing in a replicating portfolio is no, so what you're basically doing in a replicating portfolio, that is delta shares method, I'm sorry. In a replicating portfolio, you have a loan. Plus some shares. Okay, loan is a negative value and shares are positive. I mean, when you buy shares, you're getting positive this thing, right? So this shares, let us take this shares as delta shares. Now, what is this whole delta? Where did this suddenly delta come from? Delta is change in option price is a Greek. We discussed about it yesterday due to change in stock price. So in our example, the option price has changed by what? 1 minus 0. It is moved. What is the volatility in the option price? It is 1 or 0. And what is the volatility in the stock price? It has changed from 66 to 54. Just hold on for 1 second. No, I think this is not working. I'll have to get a different pencil. Just hold on for 1 sec. Yeah, I'm sorry. So the share has moved from 66 to 54, during which the option has moved from 1 to 0. So the change in option, the volatility in the option is 1, whereas the volatility in share price is 66 minus 54, which is 12. So delta is 1 by 12. Delta is 1 by 12. 1 by 12. This is also known as hedge ratio. So if you have, one hedge ratio is basically the ratio at which the number of calls and the relationship it explains between the calls and the shares. So what it says is, I'm sorry, excuse me. What it basically says is, for one call, one call will replicate changes in 1 by 12th of a share. So you see, why am I saying that? The share price had moved 12 rupees, but the call price has moved only 1 rupees. So a share has to move 12 times for a call to move 1 rupee. Right? A share has to move 12 rupees for a call to move 1 rupee. Or for a call, or a share or a call replicates whatever is the change in number of what change in the price of the share, 1/12 shares, 1/12. Okay, so 1/12 of a share, whatever happens, that is the, I think I said it ulta. My bad, actually. Yeah, so 12 calls replicate the change in one share, or one call replicate share in 1/12 share. Okay, this is basically the hedge ratio. Right, now coming back to why we are talking about this delta, just assume that you have a portfolio of loan plus delta shares. Assume that loan, you have borrowed some money plus you have taken delta shares. Okay, delta shares is today's price. Now this loan, let us call it as L. Now it can be a positive number or negative number. It is negative. Loans are negative numbers, right? Please keep that in mind. Now this loan on today you have a loan plus delta. What is delta? Delta is 1/12, right? Into share. What is today's share price? Today's share price is 60. Why? Because spot is 60. Please see here. Spot is 60, right? So value of this portfolio today is L plus 1/12 of 60, which is L plus 5. Okay, today the value of this portfolio is L plus 5. Now, what will happen to the value of this portfolio after 1 year? After 1 year, the value of this portfolio will be, the loan will have a future value. Why? You borrowed a loan today, so tomorrow there is an interest that gets accrued, right? So future value of loan plus 1/12 of either 66, or future value of loan plus 1/12 of 54. Correct? Either it can be this or it can be this. Now, right. Now, what is the 1/12 share of 66? 1/12 share of 56 is 5.5, right? Future value of loan plus 5.5, and future value of loan plus this comes to how much? Plus 4.5, right? Now, what is happening is this portfolio of loan plus shares. Okay, we are looking at which method? We are looking at the replicating portfolio method. If this portfolio has same payoff as options, this is an assumption. We're assuming that this portfolio has same payoff as options. Then the original value of portfolio is same as original value of options. I'm repeating. If portfolio A has same payoff as options, then present value of portfolio A is same as present value of option. This is a fundamental theory, if this is what I was telling you, basically, there is principle of no arbitrage. There is no arbitrage that is possible. If today I have a gold chain that is valued at 1,000, and I have another gold biscuit that is valued at some number. If both of them are growing by the same amount, or both of them are giving you same absolute return, then their in beginning value, if they both have same ending value, right? So let us say I have a gold chain and I have a gold biscuit. If both of them have same ending value after change in gold prices, then they will have same beginning value. Right. So the chain and the biscuit, both of them will have same beginning value. Only then it is possible that they have same ending value. Same logic applies. If there is a portfolio of delta shares plus loan, and if its value is same as the value of the option towards the end, then the value of the option at the beginning is same as the value of the portfolio at the beginning. If future values are same, then initial values are also same. So if going by this logic, what is the future after 1 year? What is the value of this particular portfolio? Future value of loan plus 5.5 is payoff of the option. What is the payoff of the option when stock price is 66? Stock price is 66, payoff of the option is 1. And when the stock price is 54, payoff of the option is 0. So future value of loan plus 5.5 is equal to 1 and future value of loan plus 4.5 is equal to 0, which means future value of loan is how much? Future value of loan is minus 4.5. Correct? No, you substitute in this equation number 2 or equation number 1. Wherever you substitute, you'll get future value of loan is equal to 1 minus 5.5, which is minus 4.5, or future value of loan is equal to 4.0 minus 4.5, which is minus 4.5. So future value of loan is equal to minus 4.5 implies present value of loan is how much? We know that the compounding rate, what is the rate here? The interest rate is 1.05. That is the compounding factor that we use, or future value factor that we use. So then present value of loan is minus 4.5 divided by 1.05. What is it? 4.5 divided by 1.05. You get 4.28571. 4.28571. So present value of loan is equal to 4.28571. Now, what did we say? The future value of a portfolio is same as future value of a payoff of an option. Then the present value of the portfolio is the present value of the option. Present value of option is equal to present value of portfolio. So present value of option is equal to present value of portfolio. What is present value of portfolio? Which is initial value, which is loan plus 5. So is loan plus 5. Present value of loan plus 5, which is minus this minus number. Please don't forget. Minus 4.28571 plus 5 is present value of option. So present value of option is equal to 4.2857 minus 5, which is 0.7142857. 0.7142857, which I rounded it off to what? 4 decimals, no? 7142.8. 7143 or 7142. What did I round it off to earlier? 7143. So same option value. If you use the replicating portfolio method, you got the same option value of 7.1. It's 0.7143. So call option value is 7.7143. Whether you use the replicating portfolio method or whether you use this risk neutral approach. Risk neutral approach means you found out a probability, then probabilities you used it to arrive at the present value, present value of the payoffs, and finally you arrived at a value of the call option, which is 0.7143. Here, using a replicating portfolio, you got the same 0.7143. Right. This is the second aspect. Third, we have using delta shares. Right. This is delta shares approach. This is exactly it is very similar to loan plus delta shares. Okay. But here you do something different. Okay. Loan plus delta shares is equal to call. That is what we did. Here you do other way around. That is, you use delta shares minus call. So basically, you sell a call and buy delta shares. What will happen to this portfolio? I will tell you what will happen to this portfolio. Sell a call. So this is minus C plus delta shares. Delta into what is the share price today? Share. Okay. So initially minus C plus delta into 60. 60 is our spot. So that is initial value of the portfolio is minus C plus 5, right? Because delta is 1 by 12, right? Minus C plus 5 is the initial value. Now, what is ending value of this portfolio? Ending value of the same portfolio. We have two payoffs. Payoff is either 66 or 65. So what is the ending value? So beginning value, I'm just calling it as minus C because I don't know the value of the C. But ending value, I know the C value because I know what is the payoff of the option. So ending value, when spot is 66 or when spot is 54. So at this point of time, what is ending value? The payoff of the call. Call is minus C. You have sold a call. So you have to pay that 1 rupee. So minus 1 plus delta into 66, right? Because delta is 1 by 2, 1 by 12, sorry. So payoff is minus 1 plus 5 plus 5.5, that is payoff is 4.5. And when it is 54, the payoff is 0 from call, because this is minus C plus delta shares, right? That is a portfolio. This portfolio's payoff at the end is minus C plus delta shares. And we know delta is 1 by 12, share value is 66. And here the delta is 1 by 12 and share value is 54. So 1 by 12 of 54 is again 4.5. So the key point to note here is this portfolio, despite volatility, is having same value, right? What is volatility? It can move up to 66 or it can come down to 54. Despite having volatility, ending value of portfolio is 4.5. So whether it is 66 or whether it is 54, the portfolio value, what is this portfolio? C minus C plus delta shares. This portfolio is giving same outcome of 4.5. So I'll twist the story. If this is going to give you same return of 4.5, no matter what happens to the market, no matter what happens in the market, you are going to get your return. What kind of return is that? It is risk-free return. So this portfolio generates risk-free return, right? So future value is 4.5, present value at risk-free rate is 4.5 by 1.05. So present value is equal to 4.5 by 1.05, which is 4.2857. This is the present value of this portfolio. But present value of the portfolio of minus C plus delta shares. This is the present value of the portfolio. But what is the value of minus C plus delta shares? Is equal to minus C plus 1 by 12 into 60, because this is a present value terms. No, we're talking today. So minus C plus 5 is equal to 4.2857, which implies C is equal to 5 minus 4.2857, or C is equal to 0.7143. So again, you got the same number. So no matter which way you do, you see from the top, you see from the bottom, you see from the side, you use whichever method that you use, you will get the value of the call option as same number of 0.7143. Okay, so I hope I've been able to explain the entire system of how a call option is valued under binomial, in binomial delta shares method, where you sell a call and have delta shares, or portfolio replication method where you have a loan plus delta shares. Either ways, you get the same answer. And risk neutral method where you use probability and compute the present value of expected payers of the option as the price of the option on initial date. Okay, so these are two important methods. Then you have the Black-Scholes method. Then you have the Black-Scholes method. Then you have the Black-Scholes method. Now, what is the formula for Black-Scholes method? I think I've already shared this. If I'm not, yeah, it's called Black-Scholes or Black-Scholes-Merton. S0 into ND1 minus K into e power minus RT into ND2. Right? This is the formula. If you look at our formula sheet, what we give also, we've explained this clearly. There is a formula sheet. Call option value. Call option value is, I'm zooming in, S0 into ND1 minus K into e power minus RT into ND2, and D1 and D2. N means normal value, the cumulative normal value of a standard normal distribution for D1. And D1 is defined as natural log. of S0 by K plus R plus sigma square by 2 into T by sigma root T. Right. So this is, and D2 is defined as D1 minus sigma root T. Okay. So what are the things that we have? Call option is this, and D1 is equal to natural log of S0 by K plus R plus sigma square by 2 whole thing into T by sigma root T. Now, you know, S0 is spot, you know, K as strike price, E per RT is continuous compounding, T is time to expiry, R is risk-free interest rate, then ln is natural log, sigma is standard deviation, sigma square is variance. If you have all these data points, you can find out the value of a call option. And how do you find out the value of a put option? I will not give you this, but you can use put call parity, or you can, you know, there's a formula for put option also under Black-Scholes model, you can compute it. Okay. We have not been asked too much of that in our syllabus, but it is there. If you don't get it also, find out using call and then substitute it in the put call parity formula. What is put call parity? C plus K into E power minus RT is equal to P plus S0. So P is equal to S0 plus K into E power minus RT. Sorry, minus S0 plus K into E power minus RT plus C. So you can substitute it in this and get the value of the put option also. Okay. Or there is a formula which you can, which is there in the, you know, is there in the material. You can look at up for put option as well. Now, why I am discussing about this Black-Scholes formula is because in some questions that we're going to discuss, both in normal, you know, call option pricing as well as real options, we are going to use this concept of Black-Scholes. Now, one more point I want to tell you, in this Black-Scholes, there is a modified Black-Scholes. Black-Scholes with dividend. If the dividend is given in rupee terms, the dividend is given in rupee terms and not in yield terms, then you adjust the dividend only in the spot. Right? Let's say spot is 60. Dividend is given as 2 at the end of the contract. So what you do is 60 minus present value of 2. Okay, so you compute the, they will give you when the dividend is paid and all. There's a question also in the material, we'll solve it. You compute the value of 2 and subtract that from the spot, and you substitute it in this particular formula, everywhere in this formula, right? But if they give it to you in yield form, if they give it to you in yield form, where there is going to be a change in the, where there is going to be a dividend yield, then what you do is, this whole formula changes as S0 into E power minus QT into ND1 minus K into E power minus RT into ND2 divided by, and D1 is equal to natural log of S0 by K into R plus sigma square minus your Q, which is your basically the dividend yield compounding rate. So you adjust for it both here as well as here. You introduce a new term called Q. This we are going to discuss when we come to the real options aspect as well. Right. So now moving forward at this. This is the Black-Scholes formula. Let us now go and directly look at some problems. And then wherever we have doubts in problems with respect to formula and all, we'll come back and we will discuss respective aspects. Right. So coming back, what are the questions that I wanted to solve? I think I have written a list here. Options may, I'm going to solve question number 8, 9. Okay, let us see what are 8 and 9. So I'm not going to solve simple questions on calls and puts and all of that. I'm going to rather solve questions that involve some amount of working. I'm pretty much sure that all of you know what is a call, what is a put. Call is the right to buy, put is the right to sell. Buy call is different from sell put and all of that. So all those we'll keep aside. We'll not get into very basic problems because I presume that you already know. We are actually going to more in a revision mode rather than in a understanding mode. I specifically wanted to teach you this risk neutral, binomial, and basically the portfolio replicating approach because a lot of students had doubts, and in the immediately previous exam there was an issue with respect to that. Right. So I didn't want anyone to lose out on knowledge of that particular thing. But rest of it, call, buy, put, all of that, call, put, buy, sell, everything, I'm pretty sure you know. Okay. Now let us look at the first question. This is first question is question what you see on the screen is question number 8 in our P590 book. If you don't have the book, you can download it on our website. This is the book. This is what I'm taking it from. The latest version is available on our website. You can actually download it and then start solving it along with me. So let us look at this particular question. Mr. Dayal is interested in purchasing equity of ABC, which are currently selling at 600. Currently selling at 600 means spot is 600. He expects that the price of a share may go up to 780 or go down to 480. Okay. So currently it is 600, may go up to 780 or come down to 480. The chances of occurring of such variations are 60% and 40%. This is 60%, this is 40%. Please note, these are his estimates of probability. These are not risk neutral probabilities. Risk neutral probabilities you only have to arrive at. You cannot take the percentage points that they have given. The percentage, it is not fair of institute to actually give that. Okay, very unfair, because you should not confuse students. So you should check on understanding. You should not check on unnecessarily complicating by giving things which are not required. Okay. A call option on the shares of ABC can be exercised at the end of the 3 months at a strike price of 630. So K is equal to 630. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? So you basically have to find out delta. Share, what combination of share and option, right? So if this is 780, this is 480. Assume that you have an option with strike price of 630. So I put the data here. You have to find out P. You have to find out, first of all, delta. What is delta? Delta is CU minus CD by SU minus SD. What is the value of the option? So if the strike price is 630 and the market price is 780, what is the value of the option? Value of the option is 150. And if the strike price is 630 and market price is 480, value of the option is 0. Why? Because you will want to buy something in the market at 480, a call option, instead of agreeing to exercise your option to buy it at 630. So 150 minus 0 is CU minus CD, and SU minus SD. What is SU and what is SD? Simply 780 and 480 by 780 minus 480. So this is what I've done here. 150 minus 0 by 780 minus 480, which is 0.5. So the answer to that first question is what combination of share and option? So please always note this one more point. Delta is number of, it is the, if when you say delta of 0.5, it means for every option, you need 0.5 shares, or for every shares, you need 2 options, right? To hedge. The ratio here is the option is moving by 150, but the share is moving by 300. So the option moves only by 50% of what a share moves, right? So if you have 2 shares, the movement, if you have 2 options, the movement in 2 options will equal to movement in 1 share, right? So movement in 2 options will equal to movement in 1 share. So the delta of 0.5 basically means that only. That is, for every share you need 2, or for 1 share, the movement in 0.5 share will give you movement in 1 option. Okay, because here this is 300, this is 150. The share is moving by double of the option. So the 0.5 depicts basically how many number of shares you require to equal the movement in option. Okay, so you basically should say Mr. Dayal should sell 1 call and buy 0.5. So always the number of options will be more. Even if delta is given as 0.9, it basically means what? If there is a movement of 1 rupee in the share, it will the option will move by 0.9 only. So you need 1.1 options. How did I get 1.1? 1 by 0.9. You need 1.1 options to mirror the movement in 1 share. So the number of options required to hedge will always be more. The number of shares, if it is 1, the number of options will be more. If the option is 1, shares will be less than 1. Please note. So if you sell 1 call, you have to buy 0.5 shares, or if you buy 1 share, you have to sell 2 calls. So you have to write this specifically. Right. So this is the answer to the first question. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? Okay, then what should be the value of the option today if risk-free rate is 10%? What is the expected rate of return on the option? Okay, what should be the value of the option if the risk-free rate is 10%? So we use the data that they've given, which is 780, 480, 630, 600. What is 780 by 600? 780 by 600. 780 by 600. You will get 78 by 16. 78 by 60, I'm sorry, 78 by 60, which is 1.3. So upward movement is 1.3, downward movement is 0.8. Why? 480 by 600. 480 by 600 is 0.8. And they've given the risk-free rate as 10%. So RF is 0.1. Now, have they given E power RF? They've not given E power RF. We can assume E power RF, or you can actually compute. I think I told you guys also how to compute in calculator tricks yesterday. If you remember in the previous session, there's also a video on calculator tricks. You can have a look at that. Right. So the future, and it is for 3 months only. This is what option this is currently selling. He expects it may go up in 3 months. So it is only for 3 months. Please note this 10% is per annum. So you have to find out for 3 months. So for 3 months, the rate will be 1.025, which is what you do, 10% by 4. Right. Instead of doing 10% by 4, if you compute E power RT, E power 0.1 into 3 by 12, even then you'll get the same answer. So please don't bother. It will be very, very close. If you know how to compute using calculator E value, use it. Otherwise, you do normal compounding. So P is E power RT minus D by U minus D. What is E power RT? 1.025 minus D. What is down value? Down value is 0.8 minus 0.8 divided by, let me add a page and do it. It is more. So 1.025 minus D is 0.8 and U is 1.3 by 0.8. So you will basically get 0.225 by 0.5. If you solve for this, 0.225 by 0.5, 0.225 by 0.5. 45%. So the up move probability is 45, down move probability is 55. How is 55? 1 minus 45. And please note, these are the risk neutral probabilities you have to consider. The 60%, 40% is irrelevant for now. Okay, for now. Okay, so once you get this P 45 and 55, you find out the expected value of the option. Why? Because they've asked, what should be the value of the option today? So how do you find out the expected value of the option? Very, very simple, which is probability of up move into value of the option and up move, or payoff of the option. Value of down move probability into the payoff of the option and down move, and the present value, or the future value factor, or you bring it to present value. So probability of up move is what? 45%. So 45%. And what is the payoff of the option? You have a right to buy it at 630, even when the market is 780. So the payoff we already computed is 150. So 45% into 150 plus 55% into 0. Why? Payoff on down move is 0. Everything you do present value 1.025. So 45% of 150 is how much? 150 into 0.45 is 67.5. 67.5 divided by 1.025, which is what? Is 153 point, sorry, 67.5 divided by 1.025 is 65.85. 65.85. Okay, some of the students have asked me whether we should use 2 decimal, 3 decimal, 4 decimal. My suggestion, if they've specifically said use some decimals, use that. Otherwise, do everything in 4 decimals so that there is no problem. Nobody can ever again complain to you that decimals are not there or anything like that, right? So I have put here 65.85. I rounded off to 2 decimals, but here I put it 4 decimals, 65.8536, right? So expected value of the option is this. Now, what are they saying? What is the expected rate of return on the option? Expected rate of return. What is this whole expected rate of return on the option? See, you have an opportunity to buy it at present value of the option is 65. Now, this is one way, that is return for 3 months is 10%. This is one way to look at it. Other way to look at it is my estimate of probability. there is 60% probable it is 780. There is 40% probable it is 480. This is what institute has done, right? So there is a 60% probability it will be 780. There's a 40% probability it is 480. So it may be 780. My probability, this is my estimate, my expectation of return. If it is 780, then and I have a right to buy it at 630, I make 150. But I believe this has a 60% probability and 0 has a 40% probability. So I believe that the expected payoff is 90. I believe the expected payoff is 90. Okay. I believe that there is a very, very high chance that this, I make this much money. Right. So if I'm investing 65.85 and I'm going to get 90 in 3 months, this is again my estimate, not the risk neutral probabilities, but my estimate, then minus 90 divided by 65.85. So if this 65 can, if I invest 65 today, there is a possibility that I will I will get 150 with a probability of 60%. So my expected value is 90. So my return is 25.15 on 65.85 over 3 months. So I will get 36.6% return in 3 months. If you annualize it, you will get 146% return. I invest 65 rupees, I get 90 rupees back. So I'm getting a 36% return in 3 months period, which basically translates to 140% in over a 1 year period. Now, this is one way of looking at it, but you can always say that the option will generate a return because expected rate of return in the option, because if you assume risk neutral probabilities, then you will get only risk free return. However, if I assume my probabilities after computing the value of the option, then I will get a much, much higher return. So that is another way to look at it. Okay, this is question number 8. Now let us move to question 9, I think. It is question number 9. Yes, just give me a sec. I'll drink some water. .5 share is equal to 1 option. Yeah, so I'm just reading the comments. What are there? Okay. Okay. Moving forward. Consider a 2-year call option with a strike price of 50 on a stock whose current price is also rupees 50. So spot is also 50, strike is also 50. Assume there are 2 time periods of 1 year, and in each year the stock can move up or down equal by 20%. It can move up by 20 or come down by 20 in both the years. The risk-free rate is 6% using binomial model. Calculate the probability of price moving up and down. Also draw a 2-step binomial tree showing prices and payoffs at each node. Call option probably is a buy, spot is 50, strike is 50, upward movement is 1.2, downward movement is 0.8. There are 2 periods, the risk-free rate is 6%. So R is 1.06 because, E power RT also will come close to that. It is an American option. What is the price? R minus D by U minus D, and probability. How will you arrive at probability? 1.06 minus 0.8 divided by 1.2 minus 0.8. This is 0.26 by 0.4, which will be 26 by 40. 26 by 4 is 0.65. So 6.65 is the upward movement probability. So if you draw this diagram from origin 50, it can go up by 20%, which is 60. It can go up by another 20%, which is 72. 50 into 1.2 is 60. 60 into 1.2 is 72. Then this 50 can come down by 20%, which is 40, and this 40 can come down by further 20%, which is 32. This 40 can also go up by 20%, which is 48. So there are 3 nodes, C, D, and E in year 2. Then there are A and B in year 1. They have asked us to draw a diagram and point out the nodes and find out the payoffs. So what all that they said? Using when we calculate the probability of price moving up and down, we have already calculated. Also draw a 2-step binomial tree showing prices and payoffs at each node. So if you look at this, the price is 72. You have a right to buy at what? You have a right to buy at 50. So the payoff of the option at this node is 22. then you have a right to buy it at 50. So payoff at this node is 0. Why? If you have a right to buy at 50 and the market is at 48, you'll buy in the market at 48. Then payoff at this node is 0. Why? Because again, you'll buy in the market at 32 instead of buying it at 50. Now, how do you, and the probability of up move is 65, probability of down move is 35, 65, 35, 65, 35. Now, what do you do from this? And R is what? R we have already found it as 1.06. What you do is the value of this 13.49. How did you get 13.49 is payoffs at both the levels. You're taking expected value of the payoffs, which is 22 into 0.65 plus 0 into 0.35, whole thing you divide by 1.06. Why? Because it's moving by 1 year. So 22 into 0.65 is how much? 22 into 0.65 is 14.3 divided by 1.06. You'll get 13.49, which is what we have written here, 13.49. Same way, you compute the value of the payoffs here. And in both the cases, it is 0. So the expected value is also 0. Now you work backwards. 13.49 with 65% probability and 0 with 35% probability. So into 0.65. You get 8.76. 8.76 again is the value, expected value at this point. You bring it to present value terms, divide by 1.06. You get it as 8.27. That is how you arrive at the values of the payoffs at each of the nodes and the value of the option at the beginning of time. So you have the value of the option here, value of the option here, and value of the option, which is basically payoffs at each of the points. So this is how you work at it. 8.2725. That is what I also got. Right. So we have answered this question fully. We have understood what is supposed to be done and responded to it. Right. Now the next question that we're going to do is question number 14. Okay, let us move to question number 14. What is question number 14 here? Fresh Bakery's share price has suddenly started moving both upward and downward on a rumor that company is going to have a collaboration agreement with a multinational company. So it has become volatile. If the rumor is to be true, then the stock price will go up. But if rumor turns out to be false, the stock price will crash. To protect from this, an investor has purchased the following call and put. So he's purchased both call as well as put. Call protects you when stock price moves up. That is, you get to participate in the upside. Put protects you when the or share price falls, protected on the downside. 1 3-month call option with a strike of 52 for a premium of 2. 1 3-month put option with a strike price of 50 for a premium of 1. Assuming a lot size of 50 shares, determine the following. The investor's position if collaboration agreement pushes the share price to 53 in 3 months and investor's ending position if the collaboration agreement fails and the price crashes to 46 in 3 months. So they're saying what are the payoffs of both these options, assuming the premium that is paid also, if the share price moves to 53 and the share price moves to 46. Under both the scenarios, they're asking you what is going to be the payoff from these options. So let us see. I have a call option. We've written down all the basic points. Then if the price is 53, then what happens to the call option? You have a right to buy it at what? Right to buy it at 52. So if it is at 53, you have a right to buy at 52, you'll make 1 rupee profit. But you've already paid a premium of 2. So you made a loss of 1 rupee, right? Because payoff is 1, premium is 2, the loss is 1. So your lot size is 50. So your total payoff from the call is minus 50. Where is the lot size given? Assuming a lot size of 50 shares. We don't know how many lots he has bought and all that. Assuming per lot is 50 is the loss. Now, in the same case, what is the put options value? You have a right to sell it. What is the put option strike price? Strike price of 50. So I have a right to sell it at 50. The market rate is what? I have a right to sell it 50. Market rate is already 53. So the option is worthless. But I paid premium 1 rupee on 50. So minus 50. Right. So minus 50 plus minus 50, you lost 100 rupees if the share price goes to 53. Whereas if the share price is at 46, in case of a call option, you make money. right? So you in the case of a call option, you don't make money because your strike price is 52 and already the market price is at 46. You'll not buy anything. So in call option, you lost the 2 rupees premium. 2 rupee premium on 50 shares is 100 rupees loss. Whereas put option, you'll make money. Why? Your put option strike price is what? Put option strike price is 50. So you have a right to sell it at 50 when the market price is at 46. So you'll make 4 rupees gain minus 1 rupee, whatever is the premium. So you make 3 rupees gain on 50, which is the lot size. You make 150 rupees gain per lot. So 150 gain here and 100 loss here. You basically make a 50 rupees profit. So assuming a lot size, determine the following. What is the payoff here and what is the payoff here? So we have determined payoff in both the scenarios. So you have to say if the stock price rises, you lose 100 per lot because lot size is 50 shares. And if the stock price falls to 46, he will make a gain of 50 per lot because you have both put and call. You are entering into both of them. One of them knocks off the gain or gain and loss on each of them get adjusted. Right. So this is question number 14. So we have solved 8, 9, and 14. Now let us go to 25. So this is where we come back to these real options. Real options, what I was discussing, these are very, very important from exam perspective. Please trust me. This is a new topic that has been introduced recently. They are very, very important. So let us look at even 24 as well. Why only 25? Let us look at 24 also. Okay. So, so growth option. What is growth option? Growth option is basically, so we have, if you forgot it, I'll again refresh your memory. Growth option is like a European call. Okay. So you basically have a right to invest or right to do something. Timing or abandonment option is American put. You basically will abandon the product whenever you want. Timing option is American call. You will do something whenever when at your choice. See, the difference between growth is after a point of time, I will choose to invest or not invest. Whereas in case of a timing option, whenever I want, whenever conditions suit me, I will invest or I will do something. So that is a fundamental difference between a growth option and a timing option. In growth option, it is European. That is on this day, if it is profitable, I will do, I will not do. American, any point of time during this time, if it is profitable to me, I will do it. So that is the fundamental difference between growth option and timing option. Growth is European, timing is American. Right. Now, let us see the question here. This is question number 24. We'll solve 24, 25, 27, which are related to your real options, and they also have the black shows because I want to show you guys how you compute value of ND1, ND2, all of that in black shows as well. Right. And I also told you about the dividend yield, how adjustment gets happened, right? That is also relevant here. Now let us see growth option. And I've called it growth option. In exam, they won't tell you growth option. They may not. Okay. Please assume they will not. You have to figure out whether what kind of an option, real option it is. Right. So yes. So ABC Limited is a pharma company possessing a patent of a drug called Aidex, a medicine for AIDS patient. Being an approach drug, it holds the right of production of drugs and its marketing. The period of patent is 15 years. So a patent, please note, is valid from today till 15 years. If 1 year passes, it is valid only for 14 more years. 2 years pass, it is valid only for 13 more years. So the patent's life is fixed. Passage of time happens, then the patent life keeps getting shorter. Okay. This is very important in this question. After 15 years, any other pharma company can produce a drug with same formula. It is estimated that the company shall require to incur 12.5. So please note here, this 12.5 is a cost you are incurring or is an amount you are paying. So this 12.5 is basically the strike price. A lot of students get confused on what is the strike price, what is spot. Okay, here 12. Why? Because you are committing that amount. You are agreeing to pay that amount. You are agreeing to do something at that amount, right? You shall require to incur 12.5 for development and marketing of the drug. As per survey conducted, the expected present value of cash flows from the sale of the drug in 15 years is 16.7. So for 16 years, for 15 years, present value of cash flow is 16.7. So this is basically your spot. However, please note, if you delay this by 1 year, so if you do it only for 14 years, what will happen? The 16.7 will reduce by how much? Will reduce by 1/15th, right? Because it is 15 years. So this spot keeps reducing the further you delay, or when you choose to delay the development and then go commercial or go live, right? So what is it that they're saying? You have a right, but this right is a reducing right. The period of the right keeps reducing. So the spot value has to be adjusted for this reduction. This is where you treat it as if that the present value keeps reducing by there is a dividend component. That is how it is a reduction. So dividend is a reduction in the cost of carry, reduction to cost of carry. So spot is, but that spot keeps changing or keeps reducing as the time passes, right? If you implement it today, the present value of cash flow is 16. If you implement it next year, present value of cash flow is not 16. It is 16 minus something. What is that minus something? 1/15th of the total value gets reduced. So you have to treat this as dividend flow. Okay. Next, cash flow from previous similar type of drugs have exhibited a variance of 26.8% of the present value. So variance is sigma square is 26.8. And the current bonds of similar duration, 15 years, the yield on current yield on treasury bonds of similar duration, that is risk-free rate is 7.8%. Now they've given you natural log of 1.336 as 28.97, and they've given e power 1.005 is 0.3667, and e power minus, so this should be e power. This should be e power minus 1.17 as 0.3104. We'll figure out where they're used, how they're used. Please note, this is the formula. I told you, whenever there is a change in dividend, the spot into e power minus qt, and this spot doesn't change, please note. But this minus q will come into the D1 formula, right? So ND1 plus ST, ND1 into ST minus into spot minus ND2 into K into e power minus RT. This is a normal formula, but whenever there is dividend, because there is a reduction in the present value of cash flows, then you adjust this spot here as well as you adjust the dividend yield rate here. You don't touch this spot in natural log. Please note, that is very, very important. Okay, D1 value is this, and D2 is D1 minus sigma root T. This formula, I strongly suggest you guys, please, I don't know whether you can call it by heart, please solve 2 or 3 problems so that you know it. Right, because this is very, very important from a exam perspective. I am expecting either in this attempt or upcoming attempt a question on either Black-Scholes directly or a real option. Very, very, because that is why they've added it in syllabus here. Otherwise, they will add it for time pass. No. So they've added it for very, very specific purpose. Now, what is dividend yield rate? Is 6.67. How did I get 6.7? 1/15. Why 1/15? Because the patent's life is 15 years, and every year it gets reduced by 1/15th. 1/15th is 1/15, which is 0.0666, which is 6.67%. Strike price. I already told you the strike price, the amount that you will invest. Where is it? 12.5. That is the strike price. And this is spot. 16.7 is the spot. A lot of students get confused. What should be taken as spot? What should be taken as strike price? The amount that you're committing to invest should be taken as the strike price. Amount that you're going to get, the present value of all the benefits should be taken as spot. Okay. So this is spot. This is strike price. Time is 15 years. And sigma square is 26.8. Now, what is D1? Natural log of S by K plus R minus Q. R is your risk-free rate, which is 7.5, and dividend is 6.67 plus sigma square by 2 into T by sigma root T. So natural log of spot by K. Spot is what? 16.7 by 12.5. What is 16.7 by 12.5? Is 1.336. Natural log of 1.336. Have they given the value? Yes, they have given the value. 1.336 is 0.2897. So in the exam hall, if they are ideally supposed to give you these values, Okay, if they do not give you these values, it is very, very difficult. Okay, there is a calculator trick for this also. Okay, what is a calculator trick? I will tell you. 1.336, you put that in the calculator. Then you do square it 12 times. Into is equal to 1, 2, 3, 4, 5, 6. No, I think square root 12 times. I'm sorry, not square, square root 12 times. 1.336. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You get a value. You subtract 1. You get value, then you divide it by something. I'm not able to recollect this particular calculator trick for natural log. You square root 12 times minus 1, then you get something, and then I think again you square it 12 times. That is what it is. 1.336. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, minus 1, then into it. 1. I'm not able to recollect the calculator trick. I will upload it separately as a calculator trick video. You can go and check it. But there's a way in which you can do it. But I would still not prefer, because you cannot find out the normal distribution value using a calculator. Anyway, you cannot find out the normal distribution value using the calculator. Okay. So they've already given you natural log of 1.36.2897. So you input 0.2897 here directly. One value is already received, or one value you've already arrived at. Then 7.8% minus 6.67% plus sigma square by 2. What is sigma square? 26.8. 26.8 by 2 into time. What is time? 15. So into 15. So by sigma root t. Sigma is square root of 26.8. Don't forget this. 26.58 is your variance. So sigma is square root of variance, which is 26.8 square root. Square root of 26.8 into square root of time, which is 15. So if you solve for this, you will get a value which is 0.2897 plus something divided by this value. So you will basically get a value of 1.23177. Now this 1.23177, using this, you have to find out the area under the normal curve. How will you find out area under normal curve? They have not given it. So you have to go to the normal curve table. Please note 1.23177. Right. So I'll take you to the standard normal table. See, natural log is, if they give you Clark's table, or if you carry a Clark's book, that you can see. What was the value? 1.336, right? So natural log are given here. Natural secant, logarithm sine, squares, reciprocals, are natural logarithms, right? So if you look at this natural logarithm, 1.336. So 1.33 and 6. Right. So it is 2852 plus 44. Right. So 2852 plus 44 is 2896. 2896. Is that what we got? Is that what they've given? Yeah, 2897. See, if they give you Clark's tables in the exam, or if that book is available, go through that book. Otherwise, there's a calculator trick that I will separately upload, or probably after the break, I will show you the calculator trick because I don't recollect it offhand. Right. Now coming to 0.2897, this is what they've given, right? 133 is 0.2897. Now coming back to our normal, how to find out the area under normal curve for 1.23177. So let me go to the standard normal curve. Yeah, this is the standard normal curve. They will have to give this value. There's no calculator for trick for this. What was that? 1 point. 23177, no? 1.23 and 24. So it lies between these two. 8907 and 8925. You have to do an interpolation exercise to figure out 8907 and 8925. 1.2317. 8907, 8925. So 1.23177 lies between these two. You have to do an interpolation exercise to figure out, and you will get a value of 0.8910. I hope all of you know interpolation. So this is for 1.23. This is for 1.24. So what is it for 1.23177? So you have to divide the difference between those two, and difference between those two, and then divided by 0.01 multiplied by 0.017177, whatever that number is. If you do an interpolation exercise, you will end up at 8.8910. I am not going to teach you interpolation exercise. So you can figure it out on your own. Then D2. What is D2? D2 is D1 minus sigma root T. What is D1? Please don't do ND1. After you've computed ND1, no, don't take this value to compute D2. D2 comes from D1. What is D1? D1 is 1.23177. So 1.23177 minus square root of 26.8 and square root of 15. Right. So 1.2377 minus 2.0049, which is minus 0.7732. Now, n of minus D2 is equal to 1 minus ND2. This is another characteristic of normal distribution curve. So you have to directly find out for 0.7732. What is the value for 0.7732? Again, I will show you an approximate value. You can then arrive at it. Right. So 0.7732, what is it? 0.77 and 0.78. For 0.77 and 0.78. 7794 and 7823. If you're not able to see, I'll highlight it. These are the numbers: 7794, 7823. That is what I put. 7794, 7823. You have to do an interpolation exercise for 0. This is for 0.77 and this is for 0.78. Right. For these two, you have to do an interpolation exercise and figure out. You will get a value. You have to do 1 minus that, because what is it? N minus D2 is 1 minus ND2. So whatever is the value you get after interpolation, 1 minus that. So you'll finally end up at 0.2196. This whole story is for you to compute this value. If you make one mistake, also gone everywhere. So ND1 is 0.8910. So you bring that here into S into e power minus RT. S into e power minus RT is S is pot 16.7, e power minus RT. What is minus QT? I'm sorry, here dividend. 1 by 15 years into 1 by 15 years. So it is, see, ideally it should be 1 only. See, 1 by 15 into 15 is how much? 1, no? So ideally it should be 1, but they gave it as 1.007. So you ignore it. It is minus 1, e power minus 1. Right. Minus ND2. ND2 value already found out, 2.2196. So 0.2196 into e power into K. K is 12.5, which is the investment strike price. Minus RT. Here is minus RT. Minus 0.078 into 15. Minus 0.078 into 15 is minus 1.17. So this minus 1.17, they have already given us the value here. E power minus 1.17 is 0.3104. So you simplify this entire equation by substituting all the values. Then you will get the value of the option as 4.6192 million. Million only, no? I think they've said everything in millions only. Million. 4.6192 million. That is the answer. So it is a process that takes time. Even if you make a single mistake, you are gone. Okay, so your somebody is given Shivaji here is some thing. I don't know that. I will anyway tell you, after I come back in the post-lunch session how we will compute the natural log and calculator. But it is unfair of ICAI to not give the natural log value. So they will necessarily give the natural log value, and they will also give you e-value. They will also give you normal distribution tables. Without that, solving these kind of questions using Black-Scholes is impossible. Even if you come till ND1, ND2, how will you find out normal value, normal area under normal curve without having a normal distribution chart? For that, there is, as far as I know, there is no calculated trick on this particular calculator. Okay, so this is first question 24. We have solved this. Just give me a minute. Then we have to solve 25, 27, 28, 32. I need a water break. Here at 12:30. We'll try and wind this up as early as possible, but I think we'll take a break in the session at around 1 o'clock, plus or minus 5 minutes. Okay, depending on which way. If you're halfway through the problem, I'll finish the problem and then we'll move for a break. Okay, now question number 25. This is an abandonment option. What's an abandonment option? IPL already in production of fertilizer is considering a proposal for building a new plant to produce pesticides. You are proposing to consider a new plant. Suppose the present value of the proposal is 100 crores. Please don't directly jump into a conclusion whether this 100 is spot or whether this is strike. Wait for a few minutes and then jump into it. Without the abandonment option, present value of the proposal without the abandonment option. So the present value of the proposal without abandonment option is this. However, if the market conditions pesticide turns out to be favorable, the present value of the proposal shall increase by 30. So this 100 will become 130 if everything works fine. On the other hand, market conditions remain sluggish. The present value of the proposal shall reduce by 40%. So it shall become 60. So this present value will go up to 130 or come down to 60. In the case the company is not interested in continuing the project, it can be disposed of at 80. So at this point, you can dispose it off for 80. Right? If the risk-free rate of interest is 8%, then what is the value of the abandonment option? So in this question, there is a twist. The twist is by looking at 100, 130, 60, and 80, please don't come to a conclusion about what is spot, what is strike, what is future, all of that. Don't do all of that. Okay. Just think calmly, draw a binomial tree. 100 may go up to 130, may come down to 60. And here we are not trying to value the stock. We are trying to value the put option. Put option is to abandon. We are trying to value the abandonment option. In this case, if the project is going very well, will you abandon the project? No. When the project is going very badly, you will abandon. If you're abandoning the project, you are going to get 80 rupees, but the present value of the cash flows is 60. That particular point, if you're choosing to abandon, what is the payoff from abandonment? Payoff from abandonment is 20. So the put option, the value or the choice that you make to abandon the project will give you 20 crores at that particular point. Here, there is no need to abandon. So you are trying to present value this 80. That is the key here. So if you look at this U and D, which is what 1.3 and 0.6, right? It's going 100 is going to 130, it's coming down to 60.6. So what is the probability? Probability is same e power RT. It's not minus RT, e power RT minus D by U minus D. So what is e power RT? They've given it as 8%. No, so you can do either e value or you can do directly 1.08. So 1.08 minus 6 by 1.3 minus 6, you will get 0.48 by 7, which is 0.6857. 0.6857 is what? Is the risk neutral probability of going up. Of what? Of the project cash flows, present value of cash flows going up to 1.3 or 130 to 130 crores is 0.6857. So this is, please look at it independently. The if you will exercise the put option, and the put option will have value of 20. So when it goes up, the payoff from the put option is 0. When it goes down, there is a payoff from the put option. So you basically arrive at the value of the option as 0.6875 into 0 plus 0.3114 to 20. What is 3143? 1 minus 6875. Okay, that's all. 68, not 75, 6857. Okay. So 1.3143 into 20. What is 20? 80 minus 60 is 20. So the value of the option is payoff from the option is 6.286. 6.286 is towards the end. This is after how many years? Abandonment option. However, the market conditions increase in case the company. So they have not mentioned. We have to assume that it is one year. They have not mentioned, however, the market and present value of proposals increased by 30. On the other hand, market remains sluggish. It will reduce. They have not mentioned the time anywhere. So we have to make an assumption that the time is 1 year. So assume T is equal to 1. Okay. So 6.286, you divide it by 1.08, you basically get 5.8204. So this is the present value of payoff of put option. So that is the value of the abandonment option. So abandonment option value is 5 million. So this is how you arrive at the abandonment option value. Right. Next question, 25 you have done. Next is 27. 27 and 28. 27 is a timing option. What is timing option? You have a right to choose whenever you want to do it. Right. It is not a abandonment, but you're choosing to grow. Timing is also a positive thing, right? In this case, I'm pretty sure it is some savings or something. Let us see. MIS Limited is considering installation of solar electricity generation plant for lighting the staff quarters. The plant shall cost 2.5 crores. Don't jump into conclusion. What is spot? What is K? Wait. And it shall lead to saving in electricity expenses at current tariff by 21 lakh per year forever. However, with change in government, the rate of electricity is subject to change. Accordingly, the saving in electricity can be either 12 lakhs or 35 lakhs. So the saving can be either 12 or 35. Then currently it is 21. Okay. Current, future down, future up. Okay. Don't write anything. Just see don't jump to conclusion. Read it fully. Assuming WACC is 10%. This is WACC. Risk-free rate is 8%. Decide whether they should accept the project or not. So in this question, no, they have given 2 interest rates. They have given you 3 possible savings. You have to figure out what are you supposed to do. What is the value of this timing option? If the timing option is positive, then you should accept the project. If the timing option value is negative, you should not accept the project. So investment is 2.5 crores. Even though you are investing 2.5 crores, okay, I'll add a page here and solve it. Investment 2.5 CR. Then what have they said? Saving in electricity at 21 lakh per year. Electricity saving 21 lakhs per year. How many years? They've not said. So it is infinity. WACC is 10%. They said WACC is 10%, right? WACC is 10%. Now, these savings for the company are valued at WACC. Risk-free rate is used for valuing the option. Company savings are valued at the WACC. So 21 by 0.1 is equal to 2.1 CR. So 2.1 CR is the present value of savings today. Investment is 2.5 crores. Correct? Investment is 2.5 crores. Present value is 2.1. So when you are considering this particular option, what is the strike price? What is the spot? What is it? What is the? How do you look at all these numbers? So I would suggest in this kind of questions, you consider max of either investment or present value of savings. Right? Investment or present value of savings, which is either 2.1 or 2.5. Max of these two is what you should consider as your initial, the current spot. Right? It is 2.5 is the current thing. Now, from this 2.5, what is going to happen? Right? But from that 2.5, you are incurring 2.5 and savings is 22.1. So your net present value is only 0.4 minus. Okay, so this 2.5 is the this is not the right one. 2.5 is the investment and minus 2.1 is the saving. So you get 0.4 as the NPV. Now you look at it. What is the NPV if it is 12 lakhs or 35 lakhs? So 12 by 0.1 and so 12 by 0.1 is 120 lakhs, 35 by 0.1 is 350 lakhs. So in that case, the present value of the proposal is minus 130 and 100. So can be minus 130 or it can be 100. Currently, it is minus 0.4. Okay. So in this kind of a scenario, up move, down move. Up move is, it can be 350. Down move is 120. How is this 350? 35 by 0.1. This is 12 by 0.1. Right. Currently, it is you are investing 250. What is the payoff? Payoff at this particular point is 350 minus 250, which is 100. Payoff at this particular point is 120 minus 250, which is minus 130. Correct? So payoff is either minus 30 or 100. So you have to find out the risk neutral probability. Probability is equal to e power RT minus D by U minus D, or you can take K minus D by U minus D or R minus D by U minus D. So that will be 350 minus, sorry, not 350. It is what? And you have to find out the U and D, right? U is equal to 350 by 250. D is equal to 120 by 250. That is what? 35 by 25, which is 1.4. 112 by 25, which is 0.48. Right. So, and your interest rate is what? Here you take the risk-free rate. Risk-free rate, what have they given? They have given risk-free rate as 8%. So you take this as 1.08 minus 48 by 1.4 minus 0.48. So you get 0.6 by 0.92. So you get a probability of 0.652. So here you're not using the Black-Scholes model, you're using the binomial approach, right? So if P is 0.652, 1 minus P is 0.348, right? So if you're getting payoff after 1 year, what is the payoff after 1 year? You either get this 100 or you get minus 130. So 100 into 0.652 minus 130 into 0.348. So please note, in this case, even though it is negative, we are considering it. And I think even the material has done that way only. Even though the payoff is negative, we are considering it. We are not taking the payoff as 0. The reason is here the entire focus is on time. That is, when do you want to do it? And when you're doing it, either it can be 100 or minus 130. And 100 has a probability of 0.65 and minus 130 has a probability of 0.342. In fact, in other books, they have not considered negative probability, but ICI has, in its whatever wisdom, has considered even the negative number here, negative payoff. So you get, what is your expected payoff? Expected payoff is 100 into 0.652 minus 130 into 0.348. So you will get a payoff of 19.96. This 19.96, you again present value it by 1.08, you get 18.48 lakhs. Option has positive value and hence the company should wait and decide. So even considering this, the option has positive value. Even considering a negative value here, the option has positive value. If you don't consider the negative value, the option will always be positive. If you don't consider this negative value, option will always be positive. Why? Because there is a positive payoff. No, there is a positive payoff here. If you don't consider negative value, the option will have positive payoff. So ICA has done it this way, saying that you have to assume even the negative payoff and multiply the probability to arrive at the expected payoff. So expected payoff here is 19.96 and present value of expected payoff is 18.48. So what you come and say is, decide whether MI should accept the project or wait and decide. Because there is an option and the option has positive payoff, you should accept. You should wait. This is the timing option. When will you say don't wait? If the option has negative value, you'll say, boss, option anyway is worthless. Option, there is no value to the option. Don't wait, don't take up the project. Right. Okay. When will you take up the project? When it starts becoming 35, then you'll choose to take up the project. So you're waiting. The value of that waiting, present value of all that waiting that you have done is 18.48 lakhs. Okay, so this is next one. Then we go to question number 28 and 32. These are the last two questions. Describe each of the following situation, the language of the option. So this can come in MCQs, which is why I have tried to give it here. This is a very important thing, as I'm saying, because first time you're getting MCQs in the exam, there's a possibility that you will be asked questions on real options as well. Drilling rights to underdeveloped heavy crude oil in North Alberta. Okay, this is the question. Development and production of oil is a negative NPV endeavor. That is, the break-even price is 32 per barrel versus a spot price of 20. Spot is 20, break-even price is 32. However, decision to develop can be put off for up to 5 years, and development costs are expected to increase by 5 years. Describe this in the language of options. So I am trying to help you how this you should say. This is a you can choose to put off. If you're choosing to put off, what is it? Is it growth, timing, or is it abandonment? You can put off for 5 years. So it is basically an American call option. You're choosing when to do, right? It is not abandonment. You don't have a right to abandon, right? So I mean, you're delaying it. You're delaying the project. So it is an American call. What is an American call? I explained it to you also here. American call is a timing. Abandonment is what? American put. You choose to abandon. So it's a put. You're selling it off. Whereas if you're choosing to invest, then it is a timing issue. So it's an American call option regarding drilling rights for undeveloped heavy crude oil with an initial exercise price of 32. So initially the exercise price is 32 and ability to delay the development 5 years due to increasing cost, it falls in the category of a timing option, right? So initial exercise price is 32. Right. Then a restaurant is producing net cash flows after all out-of-pocket expenses of $7 lakh per year. There is no upward or downward trend in the cash flows, but they fluctuate as a random walk with an annual SD of 15%. So this is volatility. The real estate occupied by the restaurant is owned, not leased, and could be sold for 5 million. Ignore taxes. This is a put option. Why American put option? And again, it's American put. Why? You can choose to sell whenever you want. Related to abandonment option for selling a restaurant's real estate, considering annual cash flows of 7 lakhs. So every year you're getting 7 lakhs with an exercise price of 5 million. So whenever I want to sell, I will sell it at 5 and standard deviation of 15%. All right, this is how you explain this. Then in the same part B, if the known fixed costs are 3 lakhs. So net cash flow is 7 lakhs, but the fixed costs are 3 lakhs. So the gross cash flows are 1 million. Right. So revenue less variable cost minus fixed cost. So this gross cash flows are 1 million, or cash flow before the fixed cost is 1 million. So what do you say is the fluctuating cash flow of 1 million with 10.5%. What is this 10.5%? Annual standard deviation of forecasted of the revenue less variable cost is 10.5. So they themselves have said the standard deviation of 15% is for the $7 lakh, but for revenue less variable cost, the standard deviation is 10.5 and the interest rate is 10. So this 1 million has a 10.5% variability in the fixed cost of 3 lakhs. This is not lakhs, lakhs. American put option indicating abandonment option with varying cash flows and excise price of 8. Why did excise price become 8? 5 million was sale, but you'll also save for eternity 0.3 by or 3 lakhs by 0.1. So 3 lakhs by 0.1 is 3 million. So that 3 million also, present value of that also gets added to your 5 million of sale price of real estate. So exercise prices of 8 million, including annual savings as well. Then a paper mill can be shut down in periods of low demand, restart if demand improves. The cost of closing and reopening mill are fixed. What kind of an option is this? This is whenever you want, you can start. Whenever you want, you can stop. This is both call as well as put, both American. The paper mill's ability to temporarily shut down and restart operation, fixed closure and reopening cost reflects a compound option. It is a combination of an American put for abandonment and American call for temporary restart. So it is a compound option. If you remember, in exotic options, we discussed about this. Then a real estate developer uses a parcel of urban land as a parking lot. Although the construction of either a hotel or an apartment building on the land would be NPV positive investment. So it is again a timing option. It is a situation where a real estate developer can choose between building a hotel and apartment, both profitable. It represents an in-the-money American call. In-the-money American call. It's a timing option, allowing for deferment of decision to select the most lucrative option. So you can choose whichever you want, whenever you want. Right. Then Air France negotiates a purchase option for 10 Boeings and they must confirm the order by 2030. By 2030. Anytime in the next few years, Boeing will be free to sell the aircraft to other airlines. So they are negotiating a purchase option for 10 Boeing by 2030. It represents a timing option. It is buy. And specifically in American call because you can do any point of time. This grants Air France the flexibility to confirm purchase at any time till 2030, resembling a timing decision rather than a growth or abandonment choice. So this is how all the options will look, real options will look. Now coming back to last question, I think this is 28, then coming to 32, then we can wind up the derivatives chapter and then can move to the next chapter. What is question number 32? I think this is from one of the 32. What is 32? Gold. A call option on gold with an exercise price of 26,000. Exercise price is 26 for 10 grams and 3 months to expire is being traded at a premium of 1010 per 10 grams. It is expected that 3 months from now, the spot price might change to 27,300 or 24,700. And the option is that the option is at the money. At the money means the spot is also 26,000, strike is also 26,000. Rate of interest of single compounding is 12% per annum. So they're simple compounding. They have said specifically simple compounding. Is the current premium for the option justified? So what is the premium? Premium is 1010. So they're asking us whether this is a correct premium or not. So what do you do? 26,000 is the current spot. This is also the strike. S0 is equal to K is equal to 26K. It can go up to 27,300 or come down to 24,700, correct? We are now required to find out the probabilities. So what is U? 27,300 by 26,000. 27,300 by 26,000. U is 1.05. Then 24,700 by 26,000. D is 0.95. So R minus D by U minus D. And R is what? Please remember, this is 3 months option and annual interest rate is 12%. So you should not take R as 1.12. You should take it as 1.03 because it is 1% per month. So 1.03 minus 0.95 by 1.05 minus 0.95, you get 0.8 as the number. Right, 0.08 by 0.1, which is 0.8. 0.8 is the probability of moving upwards. So this is 80%, this is 20%. And what is the strike price of the option? 26,000. So what is the payoff of the option? 1,300. Why? 27,300 minus 26,000 is 1,300. So here the payoff is 1,300, here the payoff is 0. You arrive at the expected payoff, 1,300 into 80% plus 0 into 0.2. Right, so 1,300 into 0.8 is how much? 104. So 10,000, 1040. But 1040 is the future value. What is the present value of the payoff? 1040 by 1.03. 1040 by 1.03. You'll get us 1009.71. And what is the current call option price? 1010. 1009 versus 1010. The call option is appropriately priced at 1010. Right, it is appropriately priced. Why? Because we got a price of 1009.79 and market it is quoting at 1010. It's 0.3 difference. It doesn't matter. Now, if the same thing, what else have they asked? Evaluate the option and comment that we have done. Can we do the same thing using delta method? The delta shares wala stuff. What is delta? Delta is 1,300 minus 0 by 27,300 minus 24,600. That is 1,300 by 2,600, 0.5. So for movement, you need two calls for single share. Or if you have single, or if you calls also have to be always have to be more. Or if it is 0.5 shares, then it is one call. That is the thing. So what do you do is buy 0.5 grams of 0.5 into 10 grams because all of this is for 10 grams of gold and sell a call. So if it is single call, it is 0.5 of delta is 0.5 of the gold. So 5 grams of gold you buy and sell one call for 10 grams of gold. So what is the cost of buying 5 grams of gold? 1 gram of gold today's spot is 26,000. That is what is the K also. So 13,000 minus C. 13,000 minus C is the present value of the portfolio. Up move of the portfolio, what happens? 5 grams of the gold will be worth 27,300 into 5 minus the call option, minus the call. So 27,300.5 is 1,300. So is 13,000, I'm sorry. 27.5, 27,300 is the payoff when you sell the gold at high, but you have half the gold. So 27,300 into 0.5, which is what? 27,300 into 0.5, which is 13,650. and down move of the portfolio is 24,700 into 0.5, which is 12,350. You get 13,650 or 12,350, and in both the cases, just 1 second, stretch, back is, neck is aching. Yeah, 13,650 is the, let me add a page. What is this portfolio? Portfolio is 5 grams of gold buy minus call, basically sell. This portfolio future value when it is 27,300 versus 24,700. When K is 26,000, right? So what is the value of this portfolio at this point? 5 grams of gold is worth how much? 27,300 into 0.5, and the call option is worth, you have sold a call, no? The payoff on the call option is 13. So the call option is worth 1,300. So 27,300 into 0.5 is 13,650. 13,650 minus 1,300 will be 12,350, right? In the downside, the call option will be worthless. So 5 grams of gold is 24,700 into 0.5, which is 12,350. So this portfolio, whether it is upside or downside, is generating same value of 12,350. So the present value, the portfolio, present value of portfolio is at risk-free rate. So 12,350 by 1.03 is the present value of portfolio. 12,350 by 1.03 is 22. 12,350 by 1.03. Sorry, 11. That's what I was wondering. What is 22? That is 11,990. So the present value of this portfolio is 11,990, and the present value of the portfolio when you entered into it is 5 grams of gold minus call, which is 5 into 26,000, which is the present value of the gold minus call, right? So 0.5 into this. So 11,990 is equal to 13,000 minus call, or call is equal to 13,000 minus 11,990, which is equal to 1,010. So value of the call option, even if you do this, you will get 1,010. Right. So whether you do it in the delta method, delta shares method, or you do it using here it is not shares, huh? Okay, it is delta commodity. Okay, whether you use using the delta method or you use the the risk neutral method where you find out the probabilities and value, you will get the same price. Okay, there is some rounding off, that is, you can ignore that. Now somebody was saying how to compute the natural logarithm. Where were we in that natural logarithm? Let me show. Somebody has got it. Here is this natural logarithm. Natural logarithm of 1.336. What are they saying? One 1.336. You square root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So 1.336, we square root 12 times, you got 1.00007 or something. Then step 2, you subtract 1. Then step 3, you multiply 4096 into 4096. You got 0.2896, correct. I forgot the last step. Multiply with 4096. My bad. Yeah. So you get 0.2897. I also got 0.28969. Okay. I don't know the logic of why this works on this calculator, but this is how you find out natural log. Okay. There is a calculator video, tricks video. I'll upload that if it is not already uploaded. This is how you find out natural log, but you cannot find out the value of normal distribution. Okay, so now we have completed the entire derivatives chapter, including specifically the real options, which are very, very important, both from a theory perspective as well as a practical perspective. I strongly suggest that you go through these specifically both from theory and practical perspective, because very, very high probability questions will be asked. Now that we have finished this topic, let us take a break. We'll take a break for about 45 minutes. Once we come back, what is the topic that we'll look at? Yeah, so we finished this. We finished this. We'll not do this risk management yet, because I think I've already done that revision. Any of you interested, go and check. We'll do interest rate risk management. We'll do revision of that, and we'll also try and see if we can do business valuation. Okay, we'll do revision of this plus this. I think we've solved 9. We will try and solve 8, 9 problems. There'll be some 10 to 11 problems here. We'll solve these two. With this, a lot of revisions will be done. I think 3 or 4 more chapters will be dealt, which will be left, which I would not have revised ever. One chapter is, I think, M&A. Then I've not done revision for startup, and I've not done revision for IFM. So these three I will do separately on some other day, sometime in next week. But for now, today we will try and finish these two: interest rate risk management, business valuation, and in the next week sometime we'll do M&A, startups, and international financial management. Okay, okay. Chalo. So I'll now go out and have my lunch and come back. So timer. Let me put the timer. Put timer for 45 minutes. Five, zero, zero. Start. Sharing my screen. Yeah, 45 minutes from now, I'll come back. So guys, welcome back. I hope I'm visible and audible. Okay, fair enough. I think we can start off. Okay, so we completed derivatives. In derivatives specifically, we completed the options aspect. Prior to that, we had already finished futures. Now, the next chapter that we're going to look at is interest rate risk management. This is one such chapter where there can be good quality doubts because there is a good scope for missing numbers or getting confused with numbers. But I don't think that is desired or required. We can have it without all of that as well. Right. So coming back, let us start off this particular chapter and let us see what are all the important things, what are all the various concepts, what are the problems. Even in this chapter, I think we'll end up solving about 8, 9 problems, and I think they'll help you understand the chapter much better. Okay, so let's move forward. First one, I look at theory aspects. What are the key factors affecting interest rates, demand, supply of money, inflation, and government operations? Inflation has a very strong impact on interest rates. So RBI, in order to control inflation, keeps increasing interest rates, so on and so forth. Government operation, government also is biggest borrower. So if they have to borrow a lot more money, they suck out the liquidity from the system, which will lead to increase in interest rates, so on and so forth. Right. Then what are the various types of interest rate risk? You have gap exposure, basis risk, embedded option risk, yield curve risk, price risk, reinvestment risk, and net interest position risk. So all of these you can, I will not explain each one of them in detail. But basically this gap exposure is difference between interest on borrowed funds or liabilities and assets. Then positive gap is when rate sensitive assets are greater than rate sensitive liabilities, and negative gap is ulta of that, right? And interest rates, when interest rates rise, and if you have a positive gap, your net income rises, and if you have a negative gap, income falls. And when interest rate is falling, when you have a positive gap, the interest income falls, whereas the if you have a negative gap, interest income rises. You also have something else, something called as earning at risk method to measure it, which is very similar to your value at risk. So you're basically trying to say what is the earnings that are at risk because of this particular change in interest rates. But limitations of gap, there are a bunch of limitation. It considers only the time difference between the repricing date of assets and liabilities, but fails to measure the impact of basis risk. That is, you use of different basis for assets and liability. And it does not consider defaults, delays, premature payments, so on and so forth. Then, it also fails to measure the impact of change in interest, entire impact of change in interest rate, ignores differences in times, assumes parallel shift in yield curve, which rarely happens, and doesn't consider impact of interest rate changes on non-interest based revenue. Right. Then basis risk, assets and liabilities may be linked to different kinds of basis. For example, one could be based on LIBOR, another could be based on fixed rate. So you can have different basis for assets and liabilities, which can lead to different kinds of risk. Embedded option, where you have a call or put option because of change in interest rate that gets triggered. Yield curve risk is when interest rates in market change, the price of the bond changes. There is an inverse relationship between price and yield. All of you are already aware. There is an important relationship between yield and maturity. Yield curve is a graph that plots yields of similar maturity against their maturities. Movement in yield curve are rather frequent when the economy moves through business cycle. Thus, banks should evaluate movement in yield curves and impact of that on portfolio values and income. So I'm just, briefly reading. I'm not going to explain all of them in depth because these are covered in depth in classes. Trying to explain the entire theory in depth in a revision class, I don't think is required. Just a sec. I'm just trying to fix something. Yeah. Then you have price risk. Whenever the interest rate changes, bond prices change. You have reinvestment risk. When interest rate changes, the cash flows coming from the bond, you'll not be able to reinvest at the same rate. Net interest position risk. Net interest income position risk is basically the net interest income that you're actually getting. You may be impacted by changes in interest rate. Your income versus expenditure, there may be a difference in how each of them is impacted. Now, how do you measure the interest rate risk? You have value at risk, simulation, duration, maturity gap analysis. Okay, maturity gap is for measuring the interest rate sensitivity to earnings. Duration is interest rate change to measures interest rate sensitivity of capital. Simulation is you do ALM, asset liability management simulation. Then VAR is measures the risk of loss on investments. How do banks manage the risk? They have broadly split into treasury, trading and investment or banking books, and they hold different kinds of assets in different kinds of books. Fixed and floating rates, this is where the whole story starts. You have fixed rates as well as floating rates. So you can borrow a housing loan saying that next 10 years I'll pay only 10% interest. Or you can say I'll borrow a housing loan at a floating rate. The rate will be determined every month. So this month's, whatever is determined on first of this month is applicable for the entire month. Whatever is determined on first of next month is applicable for the entire next month. Like that, you can have a rate that is determined periodically, right? You can have a frequency set, or whenever the bank changes interest rate, or whenever RBI repo rate changes. So you can actually have housing loans even linked to RBI rates, by the way. So you have these, variable benchmarks like MIBOR and LIBOR. By the way, LIBOR is no longer in existence because except for old contracts, all new contracts have, fresh contracts are supposed to be in different kinds of benchmarks. These benchmarks are different for different countries. For US, it is called SOFR, UK is Sonia, Europe is Ester, Japan is Tonar, and Switzerland is Saron. So what happened was, this is a question that actually can arise in the exam. It's a very important question, both from a MCQ perspective as well as a theory question perspective. What are benchmark rates? This is a new aspect that they've added in the syllabus. It's an benchmark interest rate is interest rate that forms basis for determination of other interest rates. So it is basically the floating rate. So when you say it is floating, entire interest rate is not floating. The spread is fixed, but the benchmark is floating. So if you say, I will borrow a housing loan at MIBOR plus 1 percentage point, then 1 percentage point, which is the spread, is fixed. But as MIBOR changes, your interest rate changes. Right. So that is what is a benchmark. They are very important for economy. Earlier, they used to be determined in UK. LIBOR used to be determined in UK. And there was a scam where people were actually making, they were defrauding customers when LIBOR was being determined. That is why they dismantled the entire LIBOR system. And now each country has their own specific benchmark. These benchmarks are used in derivative transactions as forwards, futures, options, swaps, and all bunch of other places. They are decided by an independent body after considering various factors. So even in India, MIBOR is determined by the market. Right. In financial transactions, both domestic as well as international benchmark rates are used. One of the most popular benchmarks in international financial market was LIBOR. However, after coming on news of manipulation by banks in 2012, it was decided in 17 that it would cease to exist. Accordingly, beginning 1st Jan 22, the companies are required to use alternative reference rates. And what are these alternative reference rates? They are different from LIBOR because of following reasons. They are based on actual overnight transactions, either secured or unsecured. LIBOR was always unsecured without any collateral, and ARRs are considered to be near risk-free rates with no term premium. Contrary to single LIBOR for different currencies, ARRs have different names for regulator and nature. In addition to that, they'll be referred to on basis of geographical referred locations for different currencies. So for US, it is called SOFR, decided by SF, Federal Reserve of New York, and it is secured. UK is Sonia, Bank of England, unsecured. Europe is Ester, ECB, unsecured. Tokyo is Tonan, Bank of Japan, unsecured. Switzerland is Saron, Swiss Stock Exchange, and it is secured. So this is a potential question that can actually arise in upcoming exams because it's a new topic that has been added. In India, there are many benchmark rates such as Repo, Prime, MCLR, but most common benchmark rate is MIBOR, Mumbai Interbank Offer Rate, and MIBID, Mumbai Interbank Bid Rate. Well, MIBOR is the interest rate which bank will charge from borrower. MIBID is the rate at which bank would like to borrow from another bank. They are used in majority of derivative transactions such as IRS, FRA, and floating rate debentures. So what are IRS and FRA? Upcoming. Very, very shortly, we'll be discussing that. What are various ways to manage risk? Interest rate risk management is very important. Two approaches, traditional and modern. Traditional is ALM and FRS. Modern is interest rate futures, interest rate options, and interest rate swaps. Right. How does ALM help? Basically, it is an important tool for banks. Under this process, you basically try and check what are the rate-sensitive assets, rate-sensitive liabilities. You ensure that you have enough assets which are maturing at the time when you have liabilities to pay out. FRA, this is where the real fun starts. This is where exactly even the problems that we're going to solve are also going to be linked to this. These are contracts between two parties that determine the rate of interest and notional value to be paid on agreed date. Borrower fixed borrowing cost today by entering into an FRA. Okay, so ignore what I read out. I will explain it in even simpler terms. FRA is basically an agreement between two parties. So party A, party B. Party A will say today is 1120x1. Party A says, I will borrow, will, okay, not option, compulsory, but obligation. I will borrow 100 CR from B on 1420x1 for 3 months at 10% interest rate. Okay. B says ulta, I will lend. So A is said to have long on FRA and B is said to have gone short on FRA. Now what is FRA? Forward rate agreement. Forward rate agreement. You are agreeing today itself to borrow money at a forward date at a predetermined rate. A forward date at a predetermined rate. Forward date, predetermined rate. This is what you are agreeing to do. Now, we are agreeing to borrow it at a fixed rate. But in the market on 1/4, let us say the borrowing rate for a 3 months loan is 11%. Now, this is a floating rate. Why is it floating rate? On that day, whatever is the borrowing rate is the floating rate, whereas you have agreed to borrow at a fixed rate. So, you are a wise person. Why? Or your decision turned out to be wise. Why? Because you thought interest rates will go up to 11. Let me freeze my borrowing rate now itself at 10. So you have agreed to borrow at 10%, even though the market is at 11%. And this party called B, who is typically a bank, is loser. They have agreed to lend to you at 10%, whereas in market rates are 11%. So they are the loser, you are the gainer. And forward rate agreements are typically not, they don't end in settlement, physical settlement. That is, what do you mean by physical settlement? You will not end up borrowing. You will not borrow, but you will settle. How will you settle? You will say, see, I am anyway supposed to borrow at 10, but market rate is 11. So I am smart. I made a gain. I made a gain of 1%. So 100 CR, 1% gain for a 3-month loan. So 3 by 12 or 91 by 360, whatever the day convention is. This much money is payable on 6th month. Why 6th month? Because it's a 3-month loan. So on 1/4, the relevant rate of 11% is determined, and you are supposed to borrow money at 10% and repay the same after 3 months. Why after 3 months? Because it's a 3-month borrowing. 3 months from now, you will borrow for 3 months hence, right? So it's payable after 6 months. So 6 months from day 0, but 3 months from the settlement date. So what you will do is you will present value this for 3 months. Present value this amount. The 1% gain or loss, whatever you have made, right, because of entering into the FRA, the short party will pay you that 1% gain, or you, if you're the long party, if you have made a loss, you will pay it to the short party. And that particular amount is paid on 1/4 itself. 1/4, 1st of April. Even though you enter the transaction on 1/1, 1/4 is when the rate gets determined. 1/7 is when the loan was supposed to mature. But on 1/4, you make the settlement of that by paying or receiving the present value of the differential. Then it is a net cash settled transaction. So that is actually an FRA. Let us see. A borrower fixes the borrowing cost today by entering into an FRA. I explained that to you. FRA is cash settled. Exactly. The payment is based on the net difference between the interest rate of the contract and the floating rate in the market. 11% is floating, 10% is fixed, which is known as the reference rate. The differential amount is discounted at post change, that is actual interest rate as it is settled in the beginning of the period, not at the end. So the borrower in an FRA is, or a long party, is a fixed rate payer and a floating rate receiver. 10 versus 11, no. I am willing to pay 10, I'm going to receive 11. So the difference is I am getting 1. So, and the lender is a floating rate payer and a fixed rate receiver. So if instead of 10, 11, if it had been 10, 9, even then this is fixed, I pay, 9 I receive. So I'm a loser. So the gain loss doesn't have anything to do with this. A borrower, that is the person who goes long on an FRA, is by default a fixed rate payer and a floating rate receiver. What are the main features used by banks to fix interest rate in anticipation of future deposits? It is not accounted at the time of the agreement. It's an off-balance sheet transaction. It is on notional value, that is, it does not involve actual exchange of principal. It is settled at maturity in net cash, representing the profit or loss of the period. The underlying in the contract is interest. Underlying the contract is interest. So interest rate risk management chapter, no? So this is underlying here is interest. And how do you settle? As I said, whatever is the value, 10 crores into 11% minus 10% into 3 months, 91 by 365. This is the gain you made. This gain you'll do present value. Present value at what? 1 plus reference rate. What is the reference rate? Today, the reference rate that is applicable is 11%. 11% into 91 by 365. Right. So because it is a 3-month transaction, because you agreed to borrow at 10%, whereas the market rate turned out to be 11%. You do this on day 0, enter into the contract. Day 90, the contract gets activated. The settlement happens on day 90 for a loan that is supposed to mature on day 180. Why? It is a 3-month transaction with 3-month maturity. So this if reference rate, this 11% is a floating rate, is known as a reference rate. Reference rate is greater than the fixed rate and long FRA gains. If reference rate is less than fixed rate, then short FRA gains. And the way how our FRA is nomenclature, this kind of an FRA is called 3x6 FRA. That is, I will borrow 3 months from now till 6 months from now. So that is called as a 3x6 FRA. This is months. These are always months. If you want to say years, you will say 2V, same 3V3, 3V6. I will borrow after 3 years for another 3 years period. So the eventual loan will get paid after 6 years. So I will borrow after 3 years for a period of 3 years from then. Okay, this is for years. This is for months. Typically, you get months details only. Next, what are interest rate futures? Interest rate futures, how are they traded in India? Interest rate futures are, bond futures are very similar as far as India is concerned. And interest rate futures, the underlying is the bond. Underlying is not the interest rate. It is a contract that allows the buyer and seller to agree, buyer and seller, where they agree for future delivery of a bond by locking in the price of the interest-bearing asset for a future date. So I will buy a bond at 100 rupees after 3 months. After 3, bond is not 100 but 120, and I am willing to buy at 100. So you are necessarily obligated to sell to me at 100, whereas market rate is 120. So I have made a gain of 20. So this is a interest rate future. Future is also an obligation. FRA is also an obligation on interest rates. Interest rate future is an obligation on a bond. Okay, then internationally, bond futures are delivery-based settlements, whereas IS are cash settled, but in India, both are same. Okay, in India, both of them are same. Now, there is one very, very important concept that you have to know in this. They've asked this question also in one of the previous exams, and they've asked a question both from this perspective, what our theory question perspective, as well as a practical question perspective. It's a very important question, which is, in India, this one, conversion factor into price is equal to actual delivery to the price of the given bond. We'll solve a problem on this. Okay. So what happens is, in India, if you want to enter into an interest rate future or a bond future, you will not have, most people would want to buy a 10-year treasury, 10-year government of India treasury. But 10-year treasury, exactly, government may not have issued. Government may have a 10.5, government may have a 9.5-year balance maturity treasury. So what they will do is they will artificially create a 10-year treasury based on 9.5 and 10.5 using the yields that they have, and they will create a bond. But when the bond matures, they will try and they will not make settlement against that bond, but they will make a settlement against either the 9.5-year maturity or the 10.5-year maturity. The settlement can happen at the choice of the seller. So the bond mentioned in IRF is not actual security, but artificial or notional security created with 10-year balance security. But at the time of the delivery, actual deliveries are used based on the conversion factor specified by the exchange. NSC will list out securities which can be delivered along with conversion factors, and the seller of the IRF, not the buyer, decides which bond to deliver such that the difference between the quoted spot price of the bond and the future settlement price is minimum. That is, if it's a loss, the difference is maximum. If it's a loss, the difference is minimum. If it's a gain, the difference is maximum. Such a bond is called as cheapest to deliver bond, and the conversion factor is actual delivery price of the bond is conversion factor into price of the IRF. You will understand this when I solve a problem. So please wait till that. We will be solving a problem on this. Then I think why don't we go and solve the problems, because I think we have understood about FRA and we have understood about interest rate futures. Let us go and solve these two problems, and then again we'll come back and look at interest rate options or whatever, right? Okay, let us go and solve these problems. I have noted down a couple of problems here. Let us go. Just hold on, I'm moving to the relevant page. Here. This is actually also a November 19 question. Question number 4 only, right? Yeah, 4. P Limited is contemplating to borrow an amount of 50 crores for a period of 3 months in the coming 6 months from now. So what FRA is this? For 3 months from 6 months. 6 into 9 FRA. Okay, 6 into 9. See, already I've written 6 into 9. The current rate of interest is 8%, but it may go up in 6 months' time. The company wants to hedge itself against likely interest in interest rates. The company's bankers quoted an FRA at 8.3. So they have agreed to lend you at 8.3 after 6 months for a period of 3 months from there on. Compute the effect of FRA and actual interest cost of the company. The actual rate of interest during the consideration period happens to be 8.6% or 7.8%. So 6 into 9 FRA for 50 crores at 8.3%. Right. So on fixing date, if interest rate is 8.6%, what will happen? The difference between those two, this is the formula, notional. Please, you don't need to remember the formula also. Okay. I mean, you don't need to mug up the formula. In the exam, you have to write the formula, there may probably be marks. Notional into reference rate minus fixed rate whole into days to maturity for days in a year divided by 1 plus reference rate into DTM by dy. This is the formula. So reference rate minus the fixed rate, what you have agreed, whole thing into days to maturity by days in the year. So they will specify the convention that you have to use, whether it is 360, 365, actual, what is it? Here they've not mentioned. So we can actually use a 3 by 12 or 6 by 12, things like that. That is what I've done, you see. 50 crores into 8.6 minus 8.3. You're a smart person. You agree to borrow at 8.3. Market interest rate is 8.6. So 8.6 minus 8.3 into 3 by 12. Okay, this 3 by 12 is multiplied with this 8.6 minus 8.3 number and 1 plus 8.6 into 3 by 12. So you're discounting, bringing it forward by using the current market rates. So 50 crores into 0.75% divided by 1.215%. That will give you 3,67,107.2. So the banker will pay to the company 3,67,107.2 if the company borrows at 8% interest or 8% interest. Now, what will the interest cost to the company? Interest cost to the company is, when do you pay interest? You pay interest after the borrowing is done. So in the market, you will borrow. So what is this 8.6%? 50 crores into 8.6 into 3 by 12, which is what is this? 1 crore 7,50,000. Your normal interest is 1 crore 7,50,000, but you get the money. You've already got the money from them, no? How much money did you get? You got 3,75,000 by 1.0215. So at the end of the period, you'll be making a payment of 3 lakh. You'll receiving the present value is 367, but the future value is 375. The future value when? Future value in the 9th month. And when is this interest paid? This interest is also paid in 9th month. If you're borrowing at 8.6% for how many months? For 3 months, after 6 months, the repayment is in the 9th month only, no? So in the 9th month, you'll pay this and you will receive 3,75,000. Or you have received 367 in present value terms. So in future value terms, it will be 3,75,000. So 1 crore 7,50,000 minus 3,75,000 is 1 crore 3,75,000. What is 1 crore 3,75,000? How much the interest does it work out to? 1 crore 375 by 50 CR into 12 by 3, which is 8.3%. So your effective interest cost has come down to 8.3 because you entered into an FRA. Now, if interest rate is 7.8, then you made a very, very dumb move. So 7.3 into minus 7.8 into minus 8.3. So you lost 0.5%. So 0.5% you've lost, which is 6,25,000. That again, you do present value at 7.8%. And this is the money that you have to pay. So if you made a smart decision, you will get money. If you made a dumb decision, you will have to pay the money. You have agreed to borrow at 8.3 when the market rate turned out to be 7.8. Why did it turn out to be 7.8? Because you didn't know. You thought rates will go up, but rates went down. The other party, the banker or whoever, was very smart and wise. Now, what is the effective interest rate? Same logic what we did earlier. Just a sec. 7.8%, 50 crores, 3 months is 97,50,000. To this 97,50,000, you add 6,25,000. You'll end up at 103,75,000. 103,75,000, we just now computed. 103,75,000 and 50 crores for 3 months in a year is 8.3. So once you enter into an FRA, you're basically frozen your interest cost. So it's an obligation to borrow. So your interest cost is already frozen, irrespective of what the actual interest cost is. Okay. Now let us move to the next question. Next question is question number 5, I think. So I wanted to do this one because there is some bootstrapping related activity. What is bootstrapping? We'll see. The following market data is available for spot USD JPY 116. So they've given some USD JPY foreign exchange rate 116, which is relevant, not relevant. We will see. Deposit rate for 3 months in US dollars is 4.5 and 6 months is 5. Deposit rate in JPY is 0.25 for both 3 months as well as 6 months. Forward rate agreement for yen is nil. So there is no forward rate agreement, or the rate is nil, basically. It doesn't exist. So where does it exist? FRA exists only for USD. What should be 3-month FRA rate for a 3-month forward? So at 3 months forward. So they're asking you 3 into 6 FRA. What should be the rate? How will you arrive at this rate? Well, simple to bootstrapping. This is 1 plus 5% into 6 by 12 is equal to 1 plus 4.5% into 3 by 12 plus into 1 plus X% into 3 by 12. That is what we did. Right, 3 by 12 is 4 and 6 by 12 is 2. So 1 plus 5% by 2 is equal to 1 plus 4.5 by 4 into 1 plus X by 4. So X you will get as 5.44. So please also look one more thing. For 3 months, the rate is 4.5. Whereas for 6 months from today, the rate is 5. So from month 4 to month 6, the rate has to be higher than 5, no? Only then the average comes down to 5, right? So I am borrowing rate for from today till end of 6 months is 5%. From today till end of 3 months is 4.5%. So what is the rate from end of 3 months to 6 months? It has to be higher than the average, which is higher than 5%, which obviously is here in this case 5.4388%. So what is the FRA here? FRA for 3 to 6 period is 5.4388. That is exactly, you have to just do simple bootstrapping and arrive at the rate. Then the 6-12-month LIBORs are 5.5 and 6%, 5 and 6.5% respectively. A bank is quoting 6-12 FRA at 6.5 by 6.75. Is there any opportunity, arbitrage opportunity available? Now, this is also an interesting question. USD LIBORs, 6 months is 5, 12 months is 6.5. So then 7 to 12 will be higher than these two, no? It will be some 6%, 6.5. It will be higher than 6.5. It will be close to 7. Okay. Now here we already found out 3 months, 6 months. So month 4 to month 6 is month 4 to month 6, we already found it as 5.4388. And they have also said 6 to 12 FRA is 6.5 by 6.75. What is this? This is bid, this is ask. The bank has to lend to you. They will lend at 6.5. They will enter into an FRA at 6.5, where bank is the lender. If bank is the borrower, that is, you want to lend to the bank, they will borrow at 6.5. So bid ask is relevant and important here also. Now, let us look at the key thing. In 3 months, only deposit rate is available. So in 3 months, we don't know what are the borrowing rates, so we'll ignore 3 months. For 6 months, both lending and deposit rates are available and are same at 5%, though hence no arbitrage opportunity. Why no 5%? For 6 months, USD LIBOR is borrowing rate. So this is 6%, 5%. This is also 5%, which is the deposit rate. So deposit and lending, you're not going to make any money for 6-month period. So arbitrage opportunity should exist only from 7 to 12. How do you get 7 to 12? You have 1 to 6, then you have 1 to 12. So the difference between these two is 7 to 12. For 7 to 12, you already have an FRA which is at 6.5 to 6.75. So you compare this lending or borrowing with this lending or borrowing. So you compare the FRA rate of 6.5 and 6.75 with the rates that are derived from these two numbers. So if it is for 1 year, 6.5, and for half year, it is 5. What is it for the balance half? The balance half year, it is 7.804. So for balance half, somebody is willing to lend at the cost of lending, or the rate at which the lending will happen, will be 7.804%. So for 7.804%, is somebody willing to lend. So at what rate will you borrow? If you want to borrow, you can borrow at 6.5 from the bank, because there is an FRA available. You can borrow at 6.5 and lend it at 7.804. Right. So FRA for 7 to 12 months is 6.5 and 6.75. Hence, there is arbitrage opportunity. So what you can do is, you can borrow at 5% for 6 months, and so you can do two things. You can borrow at this rate, 6.75 for month 7 to 12, and you can borrow for first 6 months at 5%. So, and what does the average rate come out to? 5% for the first 6 months and 6.75 based on the FRA for the next 6 months. You will get 5.96. Whereas you lend it out as part of FRA, you will be able to lend it out at 6.5. So that is one way you can solve it. Or you can also solve it the other way, where no, actually, that is what it is. That is what it is. So 5.96. 5.96 is the rate at which you will borrow for from market by 5% here and 6.75% here, and then you can lend it for the full year at 6.5%. So that way you actually tend to gain money. Now, how much is the gain? The difference between those two, 0.54, 5.4% for every $100. 0.54% for $100, which is 0.54%, which is $0.54 for every $100. Right. Then we go to question number 7. This is the question on that cheapest to deliver. Please see cheapest to deliver and conversion factor and all of that. This from the CFA Institute. We picked it up from the CFA Institute. A trader has sold 10-year treasury bond futures expiring in June. Now he has the obligation to deliver and right to choose which security to deliver. So he's a seller. So he has the obligation to deliver and a right to choose which security to deliver. That is the cheapest. He will always deliver the cheapest bond. The futures contract reference security is a US Treasury bond with 20 years to maturity and a coupon of 6. So the reference security is a 20-year maturity. The T-bond future size is $100,000. The futures contract settlement price is 143. The settlement price is 143. The trader needs to determine which of the following bonds is cheapest to deliver. Bond maturity, there are two bonds. One is 20X7 and X8. Price is 120 0.75, 128.5. For both of them, the settlement price is 143.47, but the conversion factor is 0.8388 and 0.8883. So 0.8388 and 0.8883. What will you do? You will multiply 143 with 0.8388. So if you come back, the futures price is multiplied with the conversion factor and you arrive at a value, and you both the cases, and you compare that with 120, which is a market price of the equivalent security. Wherever you get least loss, you deliver that, or wherever you get maximum profit, you will deliver that. Right. So let's say this is 120 and you're getting a loss of 0.407. So you will say, okay, I will deliver one against that 120. So settlement will happen against that 120. Bond A has lower loss, hence the trader will choose to deliver that. Bond A loss is 407.4. Why 407.4? 4.4074 into 1 lakh. And bond B, the loss is 1055.6. So if I'll come back, please note, this is where students get confused. The conversion factor is multiplied with the futures price. So in order to arrive at the actual price for a given deliverable bond, the comparable bonds are not multiplied with the conversion factor. Our existing future is multiplied with the conversion factor, and then you compare it with the prices of comparable bonds. And whichever bond gives you lowest loss, you deliver that, or whichever bond gives you highest profit, you deliver that. Whatever is the cheapest for you to deliver, basically incurring lowest loss or getting maximum gain. As a seller, you will deliver the cheapest bond. So that is what is called a cheapest to deliver, and this is what is a conversion factor philosophy. Okay, so this is one aspect that we have finished. 4, 8, 7. Okay, then let us look at next question. I think question 9. 9 is what? Caps and floors. For this, we have to understand the caps and floors concepts. Let's go back then. Interest rate option, also known as interest rate guarantee, is a derivative which gives the holder a right. It's a right, not an obligation. So I have an opportunity, just like a call option or a put option. So you have interest rate calls, interest rate puts. Same logic. It works the same way. You have an obligation to pay a fixed rate and receive a variable rate. So I will pay a fixed rate no matter what happens. Variable rate, whatever is there, we will do net settlement and I will make money if it is in my favor. If it is not in my favor, I'll let it expire. Right, it allows them to protect themselves against adverse interest rate movements. So interest rate options are called caps, floors, and collars. Caps is equal to sum of interest rate calls. Floor is sum of interest rate puts. So these calls are called caplets. These puts are called floorlets. And a collar is a long cap and short floor. That is a collar. Collar means you basically fix the interest rate that you pay within a band. Now, what is an interest rate cap? The buyer of a cap has a right to exercise the difference in the interest cost of the notional principal any time at a specified index of market interest rate above the supported cap rate. So I made a borrowing. Let's say I borrowed 100 crores at some market floating rate. That's some, MIBOR plus 10% or something. MIBOR plus 1% or something. If MIBOR is a floating rate, if suddenly that rate goes up to 3, 4, 5, or 6, I'm the loser, right? Because I have to pay a floating interest rate. What I will do is I will enter into a cap with MIBOR. I will say, as long as MIBOR is below 4, I don't require anything. Moment MIBOR crosses 4, okay, you pay me the MIBOR value, and in return, every month I will pay you a fixed rate of 1%, 0.5%, 2%, or whatever. Right. So the buyer need not pay anything to seller if interest rate fall below the cap. That the cap is like an option with the right rather than obligation. This is done for the premium paid by a buyer. So I will continuously keep making either I will continuously keep making a premium, or I'll pay it upfront. I'll pay upfront a premium, and whenever there is my interest rate is not in my favor, you will reimburse me the loss portion. Borrower has a floating rate borrowing related to interest rate benchmark. Interest rate cap is entered into for premium payable to the seller. It is based on notional principle. It is cash settled. It's always cash settled. The upper limit is a cap rate equivalent to a strike price. Intervals between interest reset dates and scheduled payment dates typically coincide with the term of the benchmark. Repayment amounts are determined by value of the benchmark on a series of interest rate reset dates, which are known as caplets. Calls are known as caplets, and all caplets put together make a cap. See, call is for what? A single transaction. A cap is for what? For an entire loan, all the interest payments of a loan. So multiple calls need to be there for you to make a single cap transaction. Now, how is the payment made in case of a cap? So you take notional value, multiply the maximum of 0 and difference between RA and RC. What is RA? RA is actual rate in the market, and RC is the cap rate. So if market rate is more than the cap rate, you have to pay me that money, that 1%, 2% extra, multiplied by the notional for the number of days for that particular settlement, right? Here also, they will very clearly specify what is the day convention for settlement. Okay, then what are interest rate floors? Floors are exactly ulta, where I have already lent money to somebody. I'm receiving interest every month, but the interest I'm receiving every month, suddenly, let's say the interest rates fall down, I will receive lower interest. So I will enter into a contract with a third party and say, if at all ever interest falls down below a certain percentage, you pay me the difference between the market rate and that percentage. So I will say, I want 5% every month. If interest ever falls below 5, let's say 4, the third party will have to pay me 1. If the interest rate falls to 3, third party will have to pay me 2. So this is an interest rate floor. Right. The payment also here is exactly ulta, which is the floor rate minus the actual rate. That is the difference that you get paid. Then interest rate collar. It is a specialized combination of a cap and a floor. The purchase of a collar buys a cap and simultaneously sells a floor. It involves simultaneous purchase of a cap and floor on same index for same maturity and notional principal amount. A collar protects from adverse change in interest rate on both high side and low side. So I will always continue to pay a fixed rate or in a band. If interest rates go very high, then I get compensated on the call. The interest rates go very low, then I still continue to pay because I've shorted a floor, right? So I will continue to pay interest rate, as per which is the floor limit, right? If you buy a floor, you're compensated if the interest rate goes below a floor. But if you sell a floor, you have to compensate somebody if the interest rate goes below the floor. So you're always operating in a band. Long collar is buying a cap and selling a floor, and short collar is buying a floor and selling a cap. Zero cost collar is the premium paid for the cap is equal to the premium paid for the floor. Okay, that's a zero cost collar. So I will fix the cap and floor in such a manner that the premium on the call is compensates the premium on the floor. Premium received from writing the call pays for the purchase of the put option. This is interest rate collar. You have a max of this minus max. So RA minus RC is what? Actual minus cap rate minus floor rate minus actual. Right. So max of this minus max of this into day. This is the interest that you will, this is the settlement, cash settlement that will happen whenever interest rates are determined. Then what is an interest rate swap? Interest rate swap is, it doesn't matter what the interest rate is. Every month I will pay you 5%. Every month you keep paying me whatever is the market rate. That is basically a swap. Very, very simple. Interest rate swap is a forward contract in which one stream of future interest payments is exchanged for another based on a specified principle. It is also known as swap counterparties and involves exchange of liability with fixed or floating for a liability with floating to fixed respectively. It involves exchange of liability with fixed or floating rate for liability with floating or fixed rate. So I take on the fixed liability. I have a fixed liability. I will take on a floating liability. You have a floating liability. You will take my fixed liability. That is what it is. Now, swaps can be cross-currency swaps. It can be coupon swap, principal swap. So the swap can be only for the principal portion of the loan. The swap can be only for the, interest portion of the loan. A cross-currency swap is for the entire currency, interest rate, fixed, floating to fixed. Everything is called a cross-currency swap. Or it's actually, I think there's a word also, no? Circus swap. There is a word that they've used. I think in the material also I read somewhere. They've used something called as a circus swap. Circus swap, which is basically everything put together, right? Types of interest rate swaps: plain vanilla, basis rate, asset, amortizing. Plain vanilla is simple, floating to fixed, fixed to floating. Basis rate, two different rates. That is 3-month LIBOR with 6-month LIBOR. So I pay you 3-month LIBOR, you pay me 6-month LIBOR, stuff like that. Asset swap. I will pay you return on equity index, you pay me return on bonds, whatever bond interest is. Amortizing swap, notional payment for interest payments decline during life of the swap. So the as and when the interest gets reduced, the because the amortization structure, the loan structure of repayment is amortizing. That is, every year the loan gets repaid. So in amortizing swap, the payments decline because the notional value decreases. Right. Swaption. What is a swaption? I think how many more questions? Yeah, last question, and then we'll start getting into solving problems. A swaption is an option to enter into a swap. So I have a option to enter into a swap at whenever I want. It gives the right of the it gives the holder the right, but not an obligation to enter into a swap. Fixed rate payer or call swaption is you pay the fixed and receive floating. I have an option to enter into a swap at a later date to pay fixed and receive floating. Whereas a fixed rate receiver swap is, or put swaption is, I receive fixed and pay floating at my choice later at a later date. Key features, it is effectively an option on a forward start IRS. A 3-month into 5 years option means an option to enter into a 5-year interest rate swap 3 months from now. Option period refers to time that elapsed between the transaction date and the expiry date. Swaption premium is expense in basis points, and they can be net cash settled. How are they useful? They help, they're useful to the borrowers targeting on acceptable borrowing rate. They're used for speculation, useful to borrowers and targeting a rate. And swaptions also provide protection on callable, puttable bonds. They are priced using probability-based forecasts of zero coupon yield curves. Now, we don't have too much work, or rather too many questions are not asked in the material, or they have not been asked in the exams on swaptions, but interest rate swaps, FRAs, then cap, collar, floor on these questions can be asked. Okay, now let us go and solve next set of questions. We have solved, I think, 3 questions so far. I think 4, 5, and 7. Now we have 1, 2, 3, 4, 5, 6. We have 6 more questions. Let us see those 6 questions, and then I think we can take a break after that for, I think, 10 odd minutes. Okay. Give me 1 sec. I'll just have some water. Chalo. Suppose a 1-year cap has a cap rate of 8. That is, I will pay only 8 no matter what. If it is more than 8, you have to pay me money. On a notional amount of 100 million, the frequency of settlement is quarterly and the reference rate is 3-month LIBOR. Assume that 3-month LIBOR for the next quarters is shown as follows. Calculate the payoff for each quarter. Payoff of 8% cap rate. So 3-month LIBOR is 7.7%. So I will get money only if interest rate is cap, means if interest rate is more than 8, I will get money. So will I get money here? I will not get any money. If the interest rate is exactly 8, will I get any money? I will not get any money. Interest rate is more than 8, 8.4%. Then I will get that 0.4%. So 8.4 minus 8, which is 0.4 into 3 by 12. Why 3 by 12? For each quarter into 100 million, which is $1 lakh. Then next quarter, it is 8.6. So I will get 0.6% into 100 million into 3 by 12. This works to what? 100 million by 4 is 25 million into 20 million, 1% is 0.25, 0.25 into 6. This is, yes, 1,50,000. So I will receive these two as payoffs. This is a very simple way to understand. Okay, this is not some complicated stuff. It is very simple stuff. But when you mix multiple things, one cap, one floor, then there's a collar, that is when things get confusing. And interest rate swaps also, I don't think CA Institute has done a great job. They've given some very poor quality questions. But nevertheless, I'll explain you what the issues are. Let us move to the next one. We finished 4, 5, 7, 9. Next is 10. On April 15th, DH Bank makes, or that is, it gives a 1-year floating rate loan for 10 million. Interest payments are quarterly at LIBOR plus 200. So L plus 200 means LIBOR plus 200 basis points. That is, basis point is 1/100th of a percentage point. So L plus 200 is LIBOR plus 2%. Based on actual days in the period over 360. Please note, they have said 360. Actual by 360. ACT by 360. They have made a 1-year floating rate loan. The payments are due on July 15th, Jan 15th, April 15th. Now, please note what is important here. The loan was given on 15th of April. So, first interest is due when? 15th of July. But this interest, when is the interest rate determined? Interest rate has already been determined at the beginning of the quarter. So, if you borrow money from a bank today, saying the interest rate is 10%, when do you pay and let's say interest is to be paid every month. First month you pay interest. At what rate will you pay interest? The interest rate prevailing on the date of interest payment or on the date on which you borrowed? On the date on which you borrowed. So first day on which the borrowing is made, the interest is already determined. So the floating rate of L plus 2, whatever interest it is supposed to receive, it will receive based on whatever is the rate prevailing on 15th April. So for the first interest payment, there is no, nothing is required because there is no, you cannot swap it, cap it, do it, anything. Right. So let us see. DH Bank purchases a 9-month quarterly pay cap for 85,000 with a strike price of 8.5. That is why it purchased 9 months. Why? Because the first interest is already been determined. Only for the next interest periods, the interest that is to be paid for Q2, Q3, Q4, there is required to be a cap. Right, they need a cap only for those next, say, 9 months period. Assuming LIBOR rates on April 15th, July 15th, October 15th, Jan 15th are 8, 4, 8.5, 8.65, and 8.4. Determine the 4 payoff dates on the loan interest received, any option payment received, effective net interest earned by the bank. So loan service dates, and they said actual by 360. Please remember, A by 360. So first year, July 15th, April to July, April 30 days, April, 15 days. It is on 15th, right? So 16 days of April plus 31 days of May plus 30 days of June plus 14 days of July. Why? You're paying on 15th. So interest is not paid for 15th. So this becomes 91. Like that you add for each quarter. Right. Now, first, this is what they've given a loan. So if they've given a loan, they have purchased a cap. So this is not a cap, huh? This is actually a floor. Because if you have given out a loan, only when interest rates fall below a certain rate, you are hurt, no? Right? And that is the issue. If interest rates go up, why are you affected? Your rate is great only. Right? So it is not a cap. There's a slight correction there. It's a floor. Right. So now, first floor rate is for LIBOR set on 15 July. 15 July, you will directly receive LIBOR plus 2 because floor rate is irrelevant. Because the interest rate for that is due on 15 July is already been set on 15th April, which you cannot change anyway. So nil. Right. Now, second quarter, the interest rate is set on 15 July. Right. What is 15 July interest rate? They've given it somewhere. LIBOR rates on July 15th are 8.4. 8.4 is a relevant rate. Right. And what is the floor rate that you have? 8.5. So it is, if it falls down below 8.5, you will get the difference between current market rate and 8.5. So it has fallen to 8.4. So you'll get that 0.1%. So you see here, 8.5 minus 8.4 into 92 by 360, because this is a payment is for second quarter, into 10 million. This is a 10 million loan, no? Yeah, 10 million into 92 by 360, because that is the number of days. This is the amount, 2,555.56. 2,555.56. Now, what is it in the next period? Next period, the strike is 8.5, but in the next period, the rate is 8.65. So you're getting more interest. So it doesn't matter. If you're getting more interest as a lender, if you're getting more interest, why are you bothered? You're not bothered. Then last payment is 8.4. So you're again getting less interest. So if it is again less interest, again same logic, but not the same amount, because the days have changed to 90. So 8.5 minus 8.4, which is 0.1 into 90 by 360 into 10 million, you get $2,500. Now you got inflow of 2,500 here and 2,555 here. So let us see what happened in the first for the first period, April to July, right? You got interest of how much? 10 million into LIBOR plus 2 into 91 by 360, which is basically 2,52,000. There is no floor-let concept. So 2,52,000 you directly put. Floor is 0. Floor payoff is 0. But floor payoff in quarter 2 is there. Quarter 4 is there. Same way, the payoff of the loan, because you have lent money to somebody, you will keep getting inflows, right? So for those inflows, you compute as 10 million into whatever is the prevailing LIBOR rate. So 8.4, 8.65, 8.4. So you use those rates and compute the actual interest that you will receive. So you will receive interest of 860, 265, 272, and 260. So totally, you have received an interest of 10 lakh 55,777 for a cost of 85,000. So your net interest income is 9 lakh 70,000. You see, from the floor, you made a gain only of 4,500, not 4,000, 5,055. 5055.56. What is that 5055? Basically this two. Right. Whereas the cost of that floor is 85,000. Is it even worth it? In my opinion, it is not worth it. Right. So this is how you solve a problem on floor. Now, next question is, I think 19. Nineteen, 22, 25, 28. Okay. Now, this is a steady metal question. It's a OIS, overnight index swap. Derivative bank entered into a plain vanilla swap through overnight index swap on a principal. So overnight index means it is basically there's an index which changes every day. So there's a rate that gets published every day. And these rates are MIBOR, Mumbai Interbank or offered rates. On a principal of 10 crores and agrees to receive MIBOR overnight floating rate for a fixed payment on the principal. The swap was entered into swap. Swap means there are payment out, payment in, payment out, payment in. Both payments are there. Whereas in case of an option, there is only one payment. Options, there is single payment. Caps, flowlets, there is a single payment. In case of swaps, there are two payments every time. The swap was entered into on Monday, 2nd August, and was set to commence on 3rd August 2010 for a period of 7 days. So it will start on when? Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday. So they have also said Sunday is a holiday. Sunday is a holiday means what? Data is not there, data is there, or what is it? Acha, data is not there. So this is Tuesday, Wednesday, Thursday, Friday, Saturday, and Monday. So Sunday rate is not there. If the derivative banks receive 317 net on settlement, calculate the fixed rate. So there is a swap in which you are continuously making fixed payments and receiving variable payments. We don't know what is the fixed rate, but we know that the net settlement is 317 for all the 7 days put together. Okay, so work in rupees, rounded rupees to avoid decimal working. They themselves said work in rounded rupees. Okay, so on Tuesday, they've given some rates. When you borrowed on Tuesday, 7.75 for how many crores? 10 crores. So 7.75% on 10 crores will work to 20 for 1 day, will work to 21,000. And please note the feature of this overnight index swaps is interest gets accumulated because it's a daily compounding. So previous day interest also becomes next day principal. So every day you compute 8.15, 8.12, like that you compute. And for Sunday, you take the Saturday's rate. Okay, and you compute the interest. Like that, you compute interest and see the total interest that you have paid. Total interest that you have paid is 1,53,745. But what have they said? You have paid 153. No, you have received 150. This is a pay fixed and receive MIBOR. So you have received 150, 1,53. But you also paid something such a way that the net amount is only 317, right? Derivative bank received 317 on net settlement, calculate the fixed rate. So to be received on floating. So you received 153,745, but you also paid something, but the net receipt is 317. So how much did you pay? 153 minus 317, which is 153,428. Right, 153,745 minus 317, which is 153,428. So you paid 153,428. Fixed rate for which, so now let us see this. On 10 crores, X% for 7 by 365 is equal to 153,428. Right? So you have to find out X. Simple. You solve this equation. 10 CR is 8 zeros into, sorry, by 365 into 7 by 153,428. So into 365 by 7. No, I get a value of 12.5. So I'll solve it. 10 crores into 7 divided by 365 divided by 153,428. You get 12.5. So X percentage is equal to 12.5. X percentage, 12.5 into X percentage is equal to 1. So X percentage is equal to 8%, or 1 by 12.5, which is 0.08. So 8%. So that is how you arrive at 8% number. You work backwards and arrive at it. Okay, it's a fairly simple problem. There is nothing complex, but if they ask in the exam, consider it. And we also said if Sunday interest is also compounded, then interest for Sunday is 28,887. Otherwise, it is 28,882. So because on that day you might want to compound, you might not want to compound, but that eventually doesn't impact this 8% in any large way. Then we've finished 19. Then let's go to 22. This is the question in which the CA Institute has really cooked up. I'll have to explain this in depth. May 19, old question. IM is an American firm having subsidiary in Japan. So I'm an American firm, I have a subsidiary in Japan. JI is a Japanese firm having subsidiary in USA. So where is this? I'll draw a thing. IM is in US. JJ is in Japan. You have a subsidiary in Japan. You have a subsidiary in US. Okay. Now, they face following interest rates. What are the interest rates? IM is able to get LIBOR plus 0.5 or 4%, or JI is able to get LIBOR plus 2.5 or 4.25. IM wishes to borrow in USD at floating rate. So IM is borrowing in USD at floating rate means LIBOR plus 0.5. JJ in Japanese yen at fixed rate. So they wish to borrow. You are getting it at 4.25. The current amount required by both the companies is same at the current exchange rate. So they both want to borrow some 100 million, whatever, $100 million, which is equivalent to some, 200 million JPY. I don't know what the rate is, but I'm generally saying the amounts are equivalent based on current exchange rate. A financial institution requires 75 bips as commission for arranging a swap. The companies agree to share the benefit and losses equally, whether an arrangement can be done and what is the rate of arrangement. So you see, how do you solve these problems? The way you solve these problems is, what is it that you want? What is a loan that you want? IM wants this. JJ wants this. So what is the total value of both of them put together? LIBOR plus 4.75. LIBOR plus 0.5 plus 4.25 is LIBOR plus 4.75. But let us say JJ takes in this and IM takes this. Then what will happen? And then they swap. What will happen? The total cost of this loan is LIBOR plus 6.5. So if you take, IM takes fixed and JJ takes floating, the cost is 6.5. So this, you cannot take this loan and swap it for this. See, I want something at 1 rupee. You want something at 2 rupees. If I am able to get your item at lower cost than you, and you are able to get my item at lower cost than me or some cost, and on an overall basis, there is some savings, that savings can be split. Here, there is no savings. Why there is no savings? What we want is for L plus 475. What you want me to first take is LIBOR plus 650. Why will this happen? This will not at all happen. So IM wants this. IM wants this. JJ wants this. Directly borrow, no? If instead of doing this, JJ takes this and IM takes this, what will happen? IM will say, I don't want a fixed rate, I want a floating rate. And how much floating rate? I will pay only LIBOR plus 0.5. I will not pay beyond LIBOR plus 0.5. Right? So LIBOR plus 0.5 is, how will they swap? Let us see. IM, JJ. First, borrow. Borrow at 4. So, and borrow at L plus 250. Correct? This is initial transaction. That is when you can swap to the ulta, no? Now I borrow at -4, you borrow at minus meaning I have to make these payments. But since we are swapping, let us swap and I will pay you, that is IM will pay you LIBOR plus 50. Why LIBOR plus 50? Because I am anyway getting a loan at LIBOR 50. Why will I pay you more than that? So I will pay you LIBOR plus 50. You pay me back 4. So my this 4 will get cancelled. So pay JJ, receive from JJ. Correct. So IM will say, I will pay JJ LIBOR plus 50. Let JJ give me 4. My total cost is this 4, this 4 get cancelled. My net outflow will be LIBOR plus 50 only. This is what IM will say. What will JJ do? JJ has to borrow at L plus 250. So JJ will receive L plus 50. JJ will pay basically this. And JJB will pay, which is minus 4. Right. So what is happening here? L gets cancelled. Minus 250 plus 50, which is minus 200 and minus 4%. So minus 200 is minus 2%, minus 2%, minus 4, minus 6%. This fellow is getting at LIBOR plus 50, which is what he originally wanted anyway. But I am directly getting at 4.25. Why will I now pay 6 instead of 4.25? So a swap is not possible. In this kind of a question, the swap is not possible, which is what exactly I have written. No, a beneficial swap cannot be arranged. The swapping cost increases from LIBOR plus 475 to LIBOR plus 6.5. So it is not possible. But I said that, there is a difference, hence difference can be split. It is not correct. The question itself was wrong. I will tell you how the question should have been actually framed. They should have flipped this. What do you mean flip? Here. They should have said, IM wishes to borrow JPY fixed and JJ floating. If you do this, what will happen? IM JJ. What you want? You wish to borrow. Matlab, even though you want it, initially you will not do that. That is, end goal should be that. So you will first borrow LIBOR plus 0.5. Why? Because you eventually want floating, but you will first borrow, you want fixed, but you will first borrow floating and give out that floating to somebody else. So IM will first borrow minus LIBOR plus 50. And this fellow will borrow minus 4.25. He'll do the ulta thing. 4.25. Okay, when I'm saying minus, it is an outflow for that party. Right? Then receive from JJ. What will you receive from JJ? And you will pay JJ. You will say, I will receive this entire LIBOR plus 50 because you're swapping a loan. You pay me back entire LIBOR plus 50. Okay. And I will pay you 4%. Why 4%? Because 4% is the maximum rate that I have here. Okay, I will pay you 4. So I will pay you 4. What will happen to this fellow? He will receive 4 and he will pay LIBOR plus 50. So what is the cost of the loan here? This LIBOR plus 50, LIBOR plus 50 get cancelled. Your cost of the IM loan, this is IM, loan is 4. And for JJ, the loan is, cost is 4 and 4.25. So this is minus 0.25. So here the cost will be L plus 75. So I will end up paying L plus 75. If I had directly borrowed, I would have had to pay L plus 2.5. But what was the question that I said? IM wishes to borrow USD JPY fixed. This is the correct question. They asked the question ulta. USD floating. This is the right question. So IM is getting LIBOR plus 0.5 or 4, whichever is lower. So here also they're getting 4, they're happy. And they want to borrow fixed. I changed the question, no? They want to borrow fixed, they're getting fixed. JJ, they want to borrow floating, LIBOR plus 2.5. But now they're paying only LIBOR plus 75. So they're paying lower. How much lower? 175 bips lower. Correct? LIBOR plus 2.5 and 250 and LIBOR plus 75 difference is 170 basis points. Now the question actually makes sense. Okay, so it was a very basic mistake that they made and they started evaluating papers also that I don't know what they do. Okay, now what is the thing? A financial institution requires 75 basis points as commission for arranging. So the 75 has to be paid to somebody. The companies agree to share the benefit loss equally. So what happens? Out of this 175, this fellow, LIBOR, his net payment is LIBOR plus 75. But the another 75, total gain he's made is 175. This fellow has not made any gain. IM has not made any gain. IM also needs to make a gain. What they will do is, out of this 175, pay 75 to swap dealer. Balance left is how much? 100 bips. So my cost of my loan is gone from LIBOR plus 75 to another 75. My loan has become now LIBOR plus 150. Okay, my loan has become LIBOR plus 150. Then another 100 bips is left. So I will pay this 100 again to this fellow, IM. Right? So IM, instead of me paying LIBOR plus 50, I will pay him LIBOR plus 100. So my net cost of IM's loan will be minus 3.5%. Whereas for me, the cost of the loan is, it has become LIBOR plus 150. How did it become LIBOR plus 150? Initially, it was LIBOR plus 75. Then we had to pay the swap. Total gain was 175, which is all cornered by JJ. So out of the 175, he is paying off swap fellow another 75 basis points. So it becomes LIBOR plus 75 plus 75, which is LIBOR plus 150. Then he's also paying extra 50 there. So cost of my loan is L plus 150 plus 50. So cost of my loan is L plus 2. So L plus 2. What would I get if I had directly borrowed? I would have got L plus 2.5. So here I am making a 50 bips gain. And this fellow, if I had directly borrowed, I would have made a I would have paid 4 percentage points. 4%. Now I am paying only 3.5. So I have also made a 50 bips. This is the right question. The question was wrong. And they gave a wrong answer. So they gave for the wrong answer, for the question that was wrong, the answer what I have given is correct. That no swap can be arranged. However, if you change the question like this, then correct answer can be given. Please understand this very carefully because I've seen a lot of other faculty, a lot of other people also completely jumbling this up. Okay, don't get confused. It is very simple. Please put 2 columns. How much will you receive? How much will you pay? What is the inbound? What is the outbound? You will be able to understand the question very, very clearly. Okay, we have finished 22. Then we have 2 more questions, 25 and 28. Let us see. Huh. 25. This is RTP, old RTP. A Limited is considering 50 crores, considering a 50 crore 3-year interest rate swap. Okay. The company is interested in borrowing at floating rate. So they want to borrow in floating, but due to its good credit rating, it has competitive advantage over lower rated companies in fixed rate market. So this is very similar to previous type question. Wait and watch. It can borrow at fixed rate for 6.25 or floating rate at MIBOR plus 0.75. This is a well-structured question. Presently, MIBOR is 5.25, but is expected to change in 6 months. Okay, no problem. X is an intermediary bank agreeing to arrange a swap. Okay. The bank will offset the swap risk with the counterparty. So they are going to take the credit risk. Okay, if at all there is any risk, because see, they are higher credit rating. You do a swap with a lower credit rating party. In between both, there is a risk. See, I can treat somebody else as equal. Somebody is asking whether we should follow ICA format for this chapter or we can do other ways. I think you should do what is logical. I think I explained very clearly how it is to be done. I think you should follow that rather than ICA format. Because ICA format is not very clear at all. Okay, now coming back to this question. So bank will offset the credit risk that is there between two parties. If I am, I'm good credit worthy person, I'm getting an 8%. You're a bad trade person, you're getting a 10%. How can we both swap loans? You are bad person, that is where it is costing you 10%. Tomorrow you default, then I'll be at risk, right? So intermediary bank is preferring to take that risk. Now, what is the thing? B, which is a lower credit rate company, could borrow at a fixed rate of 7.25 and floating rate of MIBOR plus 1.25. See, 6.5 versus 7.25, MIBOR plus 0.75 versus MIBOR plus 1.25. So in both the cases, A is better, but even then a swap is possible. Why? Because the question is structured properly. X Limited would charge 12 lakhs per year as its fee from each party. From each party, 12 lakhs, please note. Mr. Finn, the CFO of A, desires that A Limited should receive 60% of any arbitrage saving before payment of fees from the swap, as A is enjoying higher credit rating. So they should get whatever is the saving out of that, they should get 60% before the fees. Any fees paid to the bank are tax allowable. The applicable tax rate is 30%. You're required to evaluate the proposal. Is it beneficial to both parties or not? And assuming MIBOR was to increase to 5.75% immediately after the political crisis is over and shall remain constant for the period, evaluate the present value of savings from the swap for A, assuming the interest payments are made on semi-annual in arrears. Okay, very interesting question, very nice question. I actually liked it. Loan is 50 crores. A is able to get it MIBOR plus 75 or 6.25. This is floating. This is fixed. Okay, and B is able to get it MIBOR plus 125 or 7.25. Now, if A borrows fixed and B borrows floating, if A is borrowing fixed, they want what? Company is borrowing interested in floating. So A is borrowing in floating, but they will borrow fixed and then swap it out. Okay, so A borrows fixed, they will borrow fixed and then swap it out. And B floating, the total cost would be what? A is borrowing fixed, which is 6.25. B is borrowing floating, which is this much. Both put together is 6.25 plus 1.25, 7.5. So M plus 750. They are borrowing at this. This is much better than borrowing at M plus 75 and 7.25, which is what? M plus 8. Right? 75 bips plus 7.25 is 8%. So it is better to borrow at M plus 750 instead of borrowing at M plus 8. You borrow at M plus 750, then swap it out so that you make the gains. Total saving per annum is 50 bips. How is 50? This 800 minus 750 is 50 bips on 50 crores. 50 bips on 50 crores. 0.5% on 50 crores. 50 crores, 1% is how much? 50 lakhs. 50 lakhs by 2 is 25 lakhs. A will get 15 lakhs because 60% and B will get 10 lakhs, which is 40%. So 30 bips and 20 bips respectively. Okay, benefit for total reduction in interest for per annum. My reduction in interest for A is 15 lakhs. Why? Because we saw here 15 lakhs. And for B, it is 10 lakhs. Banker's fee is 12 lakhs and banker's fee is 12 lakhs. So your net saving is 3 lakhs. Banker's fee is 12 lakhs, net saving is 2 lakhs. You subtract tax also from that, your saving is 2.1 lakhs. And here the saving is, minus 2.4, no? So it will be minus 2.4, right? So for this fellow, it does 2.6 actually. For this person, minus, so no. This is 1.4 only, correct? I put it wrong. Minus 2 minus of minus 0.6, right? That becomes plus 0.6. So this is minus 1.4, correct one. So A is gaining money, B is not making any money. Please note here the 12 lakhs is per year. Okay. So hence the swap is beneficial only for A, as the net savings is 2,10,000, a loss of 1,40,000 for B. That is fine. Now, what have they said as the next part? Assuming MIBOR was to increase to 5.75 immediately and remain constant, evaluate the present value of savings from the swap for A Limited. Original cost is MIBOR plus 75. They wanted to borrow floating, no? And they got a 30 bips gain. So MIBOR plus 75 minus 30 is MIBOR plus 45. Savings to A is 30 bips per annum per interest payment. So 30 bips per annum. And what is the discount rate? How will you discount these? These cash flows need to be discounted at a present value factor. What is the present value factor? MIBOR plus 45. Because that is the rate at which you have borrowed. Right. So MIBOR is 5.75 plus 45, which is 6.2. 6.2 is per annum. So for 3 months, it is 3.1. Why 3 months? Because it is quarterly payment. And they said somewhere semi-annual. Where is that? Interest payments are made semi-annually in arrears. Somewhere they said quarter. No, not quarter. Actually, uh, not for 3 months. This is 6 months only. Yeah. So 6.2 is per annum. So 3.1 is per half year. So you find out the present value factor at 3.1% for 5 periods. Simple. Why 5 periods? For the first period, there will not be anything because a 3-year loan, already the first period is done. So only 5 periods are left, which are 5 half years. So for 5 half years, this is the present value factor. So present value factor is 4.5667 lakhs into 5.25 lakhs. How did we get 5.25 lakhs? Because 30 bips is saving. So 0.3 into 50 crores, 50 CR per 6 months into 30 bips into 50 crores. 5 and 8 zeros into 0.3% is 15 lakhs. 15 lakhs 15 lakhs into 0.7 because you have to subtract tax. And this is for full year by 2. So you get 5,25,000. That is how you got 5,25,000. How do you get 5,25,000? 50 crores into 0.3, which is the savings, 0.3%, which is the BIP saving, into 0.7, that is after tax, divided by 2. This is 0.3 is per annum. So for half year, you make 5.25 lakh saving. Multiply with the present value factor, you get 23 lakh saving. From that, you subtract 12 lakhs of payment that you make to from that, you have to subtract the present value of 12 lakhs payment that you're supposed to make to the arranger. So 12 lakhs is per annum. So for half year, it is 6 lakhs. So 6 lakhs into again, same 4.557 into 0.7, you get 19 lakhs. So 23 lakhs minus 19 lakhs, you make a benefit of 4.79 lakhs. Now, what are the interest payments? You keep saving the 7,50,000 every period. You subtract 30% tax, you then make payment of 5,25,000. And this is the discounting at this value. So you basically, this is how you arrive at the total. This is how you arrive at the total, payment that you are supposed to make, or rather the savings that you are going to make on this particular transaction based on the interest payment that you actually make. So this is just a working for this. Okay. This bottom part is just a working for this. So don't worry about it. Okay. So this is done. Now let us go to the last question of this chapter, question 28. And then we'll take a break for 10 minutes. Okay. Question 28. K Limited operates from 4 different buildings and wants to consolidate its operation into one building, is expected to cost 90 crores. So they're buying a building at 90 crores. The board of K had approved the above plan and to fund the above cost agreed to avail in ECB. So they're borrowing 90 crores in ECB. Borrowing of GBP 10 million from G Bank. Okay, 10 million from G Bank for following conditions. The loan will be availed on 1st April with interest payable half yearly rest. Average loan maturity is 3.4 years with overall tenure of 5 years. So average loan maturity means weighted average loan maturity based on you keep making repayments of installments. So if you take weighted average amount outstanding, divide by the total loan, or the total loan divided by the weighted average amount outstanding, if you consider that, then the tenure is 3.4 years and not 5 years. 5 years door-to-door maturity. The day you borrow and day you repay is 5 years, but you keep repaying in between. So the average maturity is 3.4. Just like the day you compute average due date and all of that in CA Foundation and Inter, right? Same logic. Upfront fee is 1.2%. This is again, I think, is for the whole tenure. Then interest cost is GBP 6 months LIBOR plus 2.5%. 6 month LIBOR is expected to be 1.05. They also entered into a hedge of 1 GBP is equal to 90. What is this 1 GBP equal to 90 rupees? Because 90 crores, no, and 10 million. 10 million is 1 crores. 1 crore into 90 is the exchange rate, adds up to 90 crores of borrowing. Okay, to cover the exposure on account of above ECB, and the cost of the hedge is coming to 4%. So hedge cost is independent, loan is independent, interest is independent. As finance manager, given the above information, taking 1 GBP is 90, calculate the overall cost both in percentage and rupee terms on an annual basis. cost, what is the cost of hedging in rupee terms? And if they want to pursue an aggressive approach, what would be the net gain or loss for K if the INR depreciation or appreciation against GBP by 10% at the end of 5 years, assuming loan is repaid in GBP at the end of 5 years? So let us see. Overall cost in INR in percentage. What is it? LIBOR is 1.5, but the spread is 250 bips. They have mentioned here, no? 6 months LIBOR plus 2.5 and 6 months LIBOR is 1.05. 1.05 plus 2.5 is 3.55. What is upfront fee? Upfront fee is paid 1.2% over the entire tenure. So 1.252% by 3.4 years. Why 3.4? That is the average tenure. And so upfront fee is either usually mentioned as per year basis, or it is mentioned as total for the overall period, and you divide it by the average tenure, right? Assuming amount is over average tenure, that's what I wrote. So it comes to 0.35. So your cost of borrowing is 3.55 plus 0.35 plus hedging cost is 4. So total cost is 7.9%. However, when you convert it into rupee, 1 crore GBP into 90 INR per GBP is the exchange rate. So GBP get cancelled. It is 90 crores into 7.9%, which is 7.11 crores. It's a very simple working. There is nothing complicated in this. Then second thing is, what is cost of hedging? Cost of hedging, we already found out as 4%, but on the loan value of 90 crores, it comes out to 3.6 crores. Then lastly, what is the last part? This is a slightly twisted part. If they want to pursue an aggressive approach, what would be the net gain loss for K if INR depreciates or appreciates by GBP against 10% at the end of 5 years, assuming loan is repaid? What is the aggressive approach? You basically don't hedge, right? If assuming INR is not hedged and INR depreciates by 10% from 90 to 99. So depreciation means INR depreciation means 90 to 99. Then value of the loan 10 million will increase from 90 crores to 99 crores, correct? You've taken 10 million loan, initially assumed exchange rate of 90, but it is depreciated by 10%, so 99 crores. Thereby loss of 9 crores is there on your loan. But you have made some saving. What is the saving you have made? Cost of hedging. This entire so here please note they have assumed that this only the principal amount is not hedged. They have not said that fixed to floating, floating to fixed, or none of the exchange rate ke bare mein, they have not spoken anything. They've only said the principal amount currency risk is not hedged. So the hedging cost of 3.6 crores, which you have paid earlier, is you have saved. So the net loss is 5.4 crores because 9 crores on currency depreciation and 3.6 crores that you gained on or saved on the cost of hedging. And if INR appreciates by 10%, then what happens? You make a 9 crore gain, right? And you also save the hedging cost of 3.6 because you've not made the 3.6 a cost. So the saving is 12.6. So this is last part is, slightly twisted, but otherwise broadly the question is appropriate. And these are the kind of questions that can be asked at certain points of time. Right. So we have finished interest rate risk management chapter. Now let us move to the last topic for the day, hopefully, which is business valuation. Business valuation, we will look at it from, we'll not go too deep. I think how many questions they have? They also have 11 questions. Let us see how much of business valuation we can finish today. Just hold on one sec. Okay, guys, we'll get back in 10 minutes. I need a 10-minute break. I've been speaking for long. Okay, guys, welcome back. We are back with the next chapter, business valuation. Now, this is also fairly important chapter because they've added again new topics in this. So, I'll just run through the basics of business valuation. I'll not go too deep. We have about 10, 11 problems here that also need to be solved. Fairly lengthy problems, actually. Business valuation is one chapter where problems do tend to be lengthy. They're not really, involved too much of thought process in terms of computation. There's no confusion, but it is lengthy. Anyway, so why do you need valuations? Because you people do acquisitions, you do, for internal use, future listing, management efficiency, strategic planning, or sometimes even startups as well. Everybody needs to have a valuation. What are the different types of valuation? Asset-based, earnings-based, cash flow-based, relative valuation. What is asset-based approach? Basically, you're valuing the assets of the company. You have a net asset value, which is basically the value of the assets of the company based on whatever is the book values, plus sometimes investment and all, you do consider market values. Net realizable value, if you want to sell them, then what is the all the assets, if you sell them, what is the value you'll get. Replacement value, value at which new assets or stuff has to be bought. So these are the asset based valuation. And the key formula here, a lot of people do tend to confuse what is net asset value. They think a mutual fund NAV kind of a thing. Net asset value is very simple: fixed asset plus net current assets minus long term debt. Basically, it is the value of your equity portion. It is value of your equity. It is basically your net worth. But please note, there are certain times, certain adjustments that are made. We will come to that when we see, because you're not subtracting the value of investments and all. You're taking only fixed assets and current assets. So to that extent, I would suggest you stick with this formula only. Okay, as we move forward, we will go and figure out deeper into that. Then you have net realizable value replacement. What are the limitations of this approach? Basically, it is dependent on historical and irrelevant inputs. Presumption of tangible assets, not suitable for intangible, doesn't consider future cash flows, doesn't consider future revenues. It is very important, it is not really useful in case of IT companies where hard assets don't exist. Then earnings or incomes based approach is basically use a P multiplier or an earnings yield multiplier, and you capitalize the earnings. These are two ways. P is P ratio is the ratio of price to earnings. So if you have a company, you're trying to value your company, you have the EPS of your company. What you will do is you will go to some other company, you will see the EPS of some other company, you will see the market price of the other company, you will divide the market price of the company by EPS of the other company, you'll get a ratio called P ratio. With that P ratio, you'll multiply with your EPS to arrive at the value of your company. Okay, it's a very simple thing. There is nothing complex. You guys have learned about this in security valuation. Bunch of other places also where you see the word called PE. In capitalization of the earnings, you capitalize. There's a capitalization rate for all the expected annual maintainable profits. Now, there are limitations of this approach also. It is followed for listed companies. It can be used to value of unlisted companies, but involves a lot of judgment. There is difference in treatment of extraordinary and exceptional items across companies. P ratio and multiples are adjusted for purpose based on practical judgments, and income-based approach can give appropriate valuation. If you make all the adjustments, obviously you get a better value. Right, then cash flow based. What is cash flow based? You have FCFF or FCFE. What is FCFF? What is FCFE? FCFF is total cash flows to the firm. Cash flows. Okay. So EBIT into 1 minus tax rate, basically your operating profit. And please note, these are all operating cash flows. Operating profit plus you add back the depreciation. EBIT is post depreciation, right? So you compute the tax post depreciation. Basically, you are excluding other income and all. How does the P&L statement look? Sales, COGS, EBIT, COGS, or let me put it in a separate sheet. Sales minus COGS is gross margin minus your or gross profit, you can call it, minus SG&A is EBITDA. SG&A is your sales general administration expenses minus depreciation. depreciation is EBIT, right? Plus other income minus interest expense is PBT, minus tax is PAT. Okay, so we are considering the number here. This is after subtracting depreciation, but before your interest expense and any other income. Right. So what you do is you take EBIT into 1 minus tax rate, that is post-tax EBIT, post-tax operating profit, add back depreciation because it's a non-cash item. Then you subtract capex and also subtract changes in working capital. So whatever the additional working capital that has gone in this year is an outflow. Right. So if you purchase more inventory and all of that, that gets reflected here. And if you've incurred capex, that gets reflected here. So this is the cash flow available to the firm. What is FCFE? FCFE is cash flow available to an equity investor. What is an equity investor? Not only do this cash flow has all the cash flows that are for debt people also, debt stakeholders also. So you subtract interest, net post-tax interest you subtract. So FCFF minus post-tax interest, and you add the borrowings made in this period. Basically, if you made any borrowing, that borrowing belongs to the company. So the money is coming to the company. So you add that back to the overall cash flow that is available. So that you get FCFE. Now, what is the value of the firm? Value of the firm is total business, is FCFF by WACC, by 1 plus WACC. Value of equity is value of firm minus value of debt. Or you can do it as FCFE by, not 1 plus WACC, it is WACC. Or you discount, basically the point they're trying to say is discounted by 1 plus WACC. FCFE, you discount it by 1 plus cost of equity. You discount it by this. Right. And this cash flow is based on free cash flow projections and then discounting the future cash flows to today's value. Determine free cash flows, project future cash flows, ascertain discount rate, find terminal value, and discount the FCF. Limitation, WACC determination, risk-free rate, market returns, systematic risk, terminal value, all of them, computation is very, very difficult. What are other approaches to cash flow based valuation? You have a capital asset pricing model, arbitrage theory. So you find out the cost of equity or a WACC using cost of equity by these two methods, capital asset pricing model or arbitrage pricing theory. We discussed about this in portfolio management chapter. Please don't forget. Then you have some concept of beta. What is beta? So beta of assets is equal to beta of equity into proportion of equity by equity plus debt into 1 minus tax rate, plus beta of debt into proportion of debt by equity into equity plus debt into 1 minus tax rate. Please note here, this is beta of assets is ungeared or asset beta. Beta of equity is geared beta. Beta of debt is debt beta. And please note, debt does not have a beta. So if you assume the weight of debt as weight, if you assume that the debt does not vary, the price of the debt does not vary based on market returns, then this becomes zero. So this entire second term, right? Entire second term becomes zero. Then beta of asset is equal to beta of equity into proportion of equity by equity plus debt into 1 minus tax rate. Right? That is what we have said. Beta of equity into equity by equity plus debt into 1 minus tax rate. Right. Beta must be unlevered or relevered to arrive at whatever the appropriate beta for the company which is being valued. So always please unlever and relever beta. This can also be adjusted like this. Okay. It is just we are simplifying the term. How is equity beta computed? Steps for computation of equity beta. Identify firms or companies engaged in same business. Identify equity beta. Unlever the beta and compute the asset beta of proxy companies. If more than one proxy company exists, take average of asset betas. Then regate the asset beta based on the capital structure of the valuing company and compute the value of the business by inputting this beta in the CAPM. Okay. Now relative valuation. What is relative valuation? Relative valuation is you find out the drivers that drive the value. So basically, what are the common drivers? You have enterprise value-based multiples like EV by EBITDA, EV by sales, EV by capital employed, PE ratio, PEG ratio, things like that. So EV by sales is used for companies without profits. EV by EBITDA is for more popular, largely for asset-based companies. Then PE ratio is for largely, FMCG or players like that. Assumptions in relative valuation, market is efficient, and firms are comparable, are similar to in structure, risk, and growth pattern. What are some other approaches? Some of the other approaches that are latestly used. Okay, please note from here the important questions start because they have added some new small topics in this particular chapter. You also use daily average users, GMV, average order value, price per page visited, price per subscriber. Such unique things are also coming up for valuing technology-based companies and startups. LBO is leverage buyout. Basically, you borrow money and buy out another company. Acquisition of another company is a significant amount of borrowed company. This is usually done by PE firms. PE is private equity firms. By putting in little of their money, PE firms can achieve larger ROE by with the arbitrage of debt. So you borrow money at 8%, generate ROE of 25%, then the entire 17% on the whatever you borrowed belongs to you. Right. Major limitation is this kind of financing is effective where future cash flows exhibit some amount of certainty. Companies that are mature, stable, cyclical, predictable can go for a leveraged buyout. What are exit multiples method? This is also a new one. An exit multiple is one of the methods used to calculate terminal value in a discounted cash flow formula to value a business. The method assumes that the value of a business can be determined at the end of a projected life based on the existing public market valuations. Analysts use exit multiples to estimate the value of company by multiplying financial metrics such as EBIT and EBITDA by a factor that is similar to that of recently acquired companies. So terminal value is valued using exit multiples. Please note. Chop shop. What is chop shop? You have a company has different businesses. Each business value it differently. Identify the industries to whom such business segment belongs, calculate value for each segment, aggregate all the segment, and there is also a discount factor usually, because when you have conglomerates, you have something called as a conglomerate discount. Then what is EVA? EVA, we all have, it has been asked in the past exam also, economic value added. The formula for EVA is NOPAT minus capital charge. NOPAT is EBIT into 1 minus tax rate minus capital charge is invested capital into WACC. Right. NOPAT is net operating profit after taxes. So this is not your operating profit. This is not your EBIT. EBIT into 1 minus tax rate typically. Right. Invested capital is total assets minus non-interest bearing liabilities. Then what is MVA? MVA is market value added. What is market value added? Market value of equity, market value of debt minus invested capital. Invested capital is same what you have found out here. What is the market value minus the book value, basically. Right. Then there is something called SVA. What is SVA? Shareholder value analysis. So in shareholder value analysis, you arrive at FCFF, discount the FCF future cash flows, FCFF basically, discount it using WACC, add the terminal value, arrive at value of the firm, reduce the value of the debt, add surplus cash, add non-core investment. So here the key thing what you have to do is EV is equal to market cap plus debt. EV is market cap plus debt. Market cap is equal to equity plus market plus debt minus cash. Market cap is equal to equity value of purely the shares plus cash plus investments. So in EV, you subtract cash and investments, or you basically take net debt. In market cap, you take equity plus cash plus investment. So when you value equity here, you're valuing from operating parts of equity. That is why you're adding surplus cash and surplus investments. In EV, you're subtracting both of them because you take market cap, which has cash and investments, which are non-operating aspects. So you're subtracting both of them independently. What is fair value? This is also, I think, a part that is asked in exam. Every valuation has its limitations. Investor who takes the ultimate decision, it is arrived at using all these methods. That is realizable value, DCF, net asset value, or current market price. You use all of these in some judgment. You make judgments as to what is right in this current situation, or you make judgment if there's a weighted number that has to be taken, an average has to be taken, or some method is completely irrelevant, and you use all of this to arrive at fair value. Right. So this is very important. A chart account perspective to a fair value would automatically envisage a transaction to be measured at arm's length. So with the price at which an arm's length transaction would take place. For a financial analyst, it would be in present value of an entity in cash terms. For a speculative investor, it would represent the arbitrage opportunity that open up among similar entities having similar values. So accordingly, following approaches can be adopted to solve question involving evaluations. Unless specified, calculate valuation by as many methods, give comments for valuation of each method, supplement your conclusion for any additional information. Then going concern and non-going concern. This is also a new topic that has been added. Non-going concern value is also known as liquidation value. It is a net realized value after disposing of all assets. Generally, the going concern value will be greater than its liquidation value. Another reason for lower value of non-going concern is liquidation not only implies laying off employees, but also creates a feeling of bad reputation. Thus, valuation based on non-going concern should be applied only when investors are of the view that firm is no longer valued as a going concern. Then distressed. How many more questions? These are all new stuff that has been added. Okay, so I want all of you guys to be very, very careful when you go through this. I think 31 questions. So we are at question number 19. So we have roughly done close to 20, right? So another 10 more questions. How does one value distressed companies? Some firms are exposed to distress. Companies that have been distressed and is unable to meet its liability. Distressed companies are likely to be already have defaulted. Conventional methods are not useful. Discounted cash flow requires terminal value, which is not there in case of a distressed company. A distressed company has negative and declining revenues, hence expected to lose money for some time. For such firms, estimating cash flows is difficult. For firms expected to fail, DCF does not work since DCF values a firm as a going concern. So even if the firm is expected to survive, projections have to be made until cash flows turn positive. So this is the key thing. If you're valuing a distressed company, you have to make projections till the cash flows turn positive. Else DCF would yield a negative value. Discount rates using conventional method reflect companies which are operationally as financially sound. They have to be adjusted for probabilities of failure. The companies will be used in case of distressed cases. So distressed companies, you do DCF till the cash flows turn positive. You use a higher discount rate. Then methods of valuation: modified discount cash flow, DCF plus distress value, then adjusted present value, and relative valuation. These are the four methods that you use for distressed companies. This is also a new thing, important thing. Please go through this carefully. Modified discounted cash flow, using updated debt to equity ratios and unlevered based estimate cost of equity. Using updated measures of default risk, estimate the cost of the debt. However, in case of ability to estimate the entire distribution, probability of distress shall be estimated for each period used as expected cash flow. Expected cash flow is cash flow into 1 minus probability of distress. So you basically, at every point of time, you take cash flow at time t and you subtract 1 minus probability of distress to arrive at expected cash flow. That you discount by weighted average cost of capital, which is based on latest cost of equity and cost of debt after considering risk of default or and stuff like that. DCF valuation to distress value. This is second method. Devaluation will understate the value of the firm. There's possibility that the firm will fail before it reaches its growth. Thus, the value of distressed firm can be computed by following undermentioned steps. What are the steps? Value the business as going concern. Determine probability of distress over the life of the DCF. Estimate the distress sale value as a percentage of book value. Accordingly, use the following formula. Value of equity is DCF value of equity into 1 minus probability of distress plus distress sale value of equity into probability of distress. So you're valuing it in two parts. DCF value of equity, whatever is equity, if you value normally, if the company survives, then plus distress sale value. You're valuing it as a distress value if the company does not survive. Then you have an adjusted present value model. This is unlevered firm value plus tax benefits on debt minus expected bankruptcy cost from debt. This is the second method. This is one more method, that is unlevered firm value, normal firm value, based excluding how we computed the unlevered beta and all of that, minus the distress sale value into probability of distress. So while the first part can be computed by discounting free cash flows to the firm, second part reflects present value of expected. The expected bankruptcy cost can be estimated as difference between unlevered firm value and distress sale value. So this expected bankruptcy costs are unlevered firm minus distress value into probability of default. So whatever is the value of the firm that is lost because of probability of default, that is the expected bankruptcy cost. So you take that separately and add it here. So it has to be looked at by combining both of these aspects. Then relative valuation. So here in relative valuation, analyzing, for example, assume that an average telecom company trades at 2 times revenue, adjust this multiple to 1.2 times for distressed telecom firm. So value distressed companies at lower multiples. That's all. Now startup valuation. This is also very important. This also come new. Earnings by cash flow approach, assets approach, especially when there are assets, market approach, comparable parameters like what we said, number of users and all of that. Right. And it is difficult to call startups established in any sense. So it is very difficult to value them. The value rests entirely on future growth potential. The major roadblock is absence indicators. There's no past track records. This is why valuation becomes critical, and role for professional comes in way of definitively helping investors navigate the way. Why traditional methods cannot be applied for valuing startups? In asset approach, there is an issue. That is, startups have negligible assets. Income approach, there is an issue because most of them don't have incomes. And startups are new, usually operate under going concern emission. Hence, their value should not be limited to realizable value of assets today. So that is why you cannot use asset approach. What are drivers for startups? Product, management, traction, revenue, industry attractiveness, demand, supply, and competitiveness. All of these drive the valuation of a startup. So startup valuation, as I said earlier, is you don't have assets, you don't have income. It is all on future growth potential. So, but how will you evaluate future growth potential using using subjective criteria like product, management, traction, so on and so forth. Right. What are various methods for valuing startup? There is an approach called Burker's approach. So this Burker approach created by firm looks at valuing startup based on detailed assessment of 5 factors: basic value, technology, execution, strategic relationships, and production consequent sales. This caps pre-revenue valuation at 2 million and post-revenue valuation at 2.5 million. And based on each parameter, a value is arrived at. I've explained this in detail in my class, the full class. You probably have to go through that, because if I were to explain this topic alone, it will take me a lot of time. Okay, then cost to duplicate approach. So how long will it take for somebody to create everything afresh? Comparable transactions. If there is a similar startup in similar space, what is the value? Scorecard. So if you have a strength of team, give some percentage. Strength of opportunity, give some percentage. Like that, give various percentages for various factors, and then compare it with other people, any other startup, and compare with their metrics, and use their value to value your startup. Then first Chicago method, it combines a discounted cash flow and a market approach to give estimate. It works out worst case, normal case, and best case. Valuation is done for each of them, and you multiply with respective probabilities. Then venture capital method is basically they are looking at a exit multiple. Based on that exit multiple, based on the market size, how much return will you get? How much return will you get at the exit time? That you discount now, and how much stake do you want now? You use that and arrive at the percentage stake that you want and the value that you are willing to ascribe. Then what are digital platform? What are various types of digital platforms? You have a marketplace, you have a search engine, you have a repository, you have digital communication, digital community. So you have varieties of digital platforms, right? So people like Booking.com, Google, Spotify, WhatsApp, Facebook, then Paytm, GPay, all of these. How are these digital platforms valued? Steps in backward working required in the top down. So you have 2 methods, top down and bottom up. In top down, analysis of total potential market, that is total addressable market, which is TAM. Estimate the share in target market. So you figure out the serviceable address market or serviceable obtainable market. Step 3, estimate its business plan to accomplish its objectives. And then this is top down. So then create a business plan, create a financial forecast, create its cash flows, forecast its expenses and all of that, and then do a DCF kind of a thing, or do a multiple kind of a thing. Then bottom up, in this, the platform can estimate its earning based on limited resources it has. A young platform can estimate its revenue and cost given its financial constraints. Under both scenarios, top down and bottom up, value of a digital platform will depend on the quality of the financial forecast. Discounting rate should be based on type of cash flows. Free cash flow to the firm should be discounted using WACC, and free cash flow to equity should be discounted using cost of equity. Right. Specific considerations, beta. Measure sensitivity to the market, but there is no market for startups. So one might have to take similar companies beta. Then survival is highly dependent on quality of management. So, quality of management determines a lot of factors of how the organization survives, what is going to happen to the organization, and all of that. Then you have a market approach. Market approach values by drawing P or EBITDA, EV by EBITDA multiples. That is another way. This is all again a digital platform valuation. It's a huge thing. Then category of digital platform, you have marketplaces, you have payments, you have community, communication, repository, search, and for each one of them, there is a different way in which you value. Then you have a cost approach. What do you do in a cost approach? Value is based on the total cost incurred to build the team, but this is not at all usually preferred. Then you have valuing a professional consultancy firm. This also is a new topic. This also can be asked in the exam, right? So in professional consultancy term, key thing that you need to know is industry key parameters and should be KPI should be identified and benchmark should be made. The main source of information are audited financials. When using income and approach with historical data is important. Projected growth also impacts the overall value. In addition to analysis of financial statements and their comparison to industry standards, normalization of income should happen. One commonly used method to analyze the extent that a firm meets expectations is comparison to current industry benchmarks and KPIs. To accurately value professional services firm, each piece of information contributes importantly. Right. So you basically value using KPIs. Using those KPIs, you compare with other firms. Using that comparison, you ascribe either a multiple or a DCF for how you're growing or how you're not growing. Right. After conversation of the management, there is inherent risk associated with future earnings potential as well as may not materialize. Hence, this risk should be factored into overall calculation. So that is what they're basically saying. Then what is ESG? Environmental, social, and governance. So this has become a buzzword. This is also a new thing. Every large corporate specifically is required to report on this because they believe that if you report on this, the standards will improve. So climate change, water, waste, emissions, biodiversity, all of these on each of these aspects, you have to basically report. Right. Summarize key developments in this space. Investment in ESG funds. There are funds which are investing only in good quality ESG companies. Then there are green bonds, bonds that are issued for making investments which are ESG friendly. Then several USG, there is a sustainable taxonomy. Taxonomy means language is on rise, and the key reasons have already defined sustainable taxonomy for EU and several other countries. And convergence of ESG framework with IFRS, they're trying to integrate EFG and IFRS. And SEBI proposed a regulatory framework on ESG. Traditional belief was ESG was good to have. However, with heightened interest from different stakeholders, it is now moving into must have. How can ESG be incorporated into valuation? As mentioned earlier, most popular technique is discounting future cash flows. Accordingly, impact of this risk can be incorporated either in discount rate or expected cash flows. Generally, management investors are interested in adjusting discount rate, even though approach is more practical, but the impact of ESG factors may not be that explicit. Hence, ESG factors cash flow should be adjusted for in ESG factors. How can impact of each factor be incorporated in cash flow? E. For environment can be incorporated by carrying a 2-degree scenario analysis. That is, your temperature of the plant increases by planet is increased by 2 degrees. Similar adjustment in cash flows can be made by considering carbon points. S. Impact of social can be considered by adjusting the impact of social measures to cost on the revenue, such as better labor conditions and so on and so forth. G. The risk of this factor can be considered by adjusting the impact of poor governance on revenue in form of penalties and fines. Okay, so you have a lot of new questions, important questions that can be actually asked in the exam. My strong suggestion, please spend time. This is available free of cost, this particular document. And if you have not already seen, I will share this one thing. We have a course on our website, AFM additional or incremental topics for May 24 exams for who have prepared for SFM under the old syllabus. Just 9.99. Please buy it because I cannot explain. It's a 26-hour class. I know exams are close by, but if you want certain topic in full detail, full depth, full clarity, please buy this because I can't explain everything in a revision class. Entire 26 hours explanation in a revision class is impossible, and you'll also not find it useful. So my suggestion, please go ahead and if you're interested, if you have not already purchased, please go ahead and enroll in this 999 rupees course so that you can actually take advantage of it and prepare it for your exam. Okay, moving back. We have looked at theory. Now let us look at practical questions. So we'll wind up today's session in another 10-15 minutes. Let me first look at the first couple of questions and see how they are. I don't remember those questions. I went through them, but I don't exactly remember which is what. Let us look at the first question. Using chop shop method or breakup value approach, assign a value for Cornet GmbH, whose stock is currently trading at total market price of 4 million. For Cornet, accounting data set is in 3 businesses: consumer wholesale, specialty, and specialty service and assorted centers. Data for 3 segments is given below: segment sales, segment assets, and segment income for each of the 3 segments. Industry data for pure play firms have been compiled and summarized as follows. For similar segments, what is the capitalization to sales, capitalization to assets, capitalization to operating income? Now you have to arrive at you have to arrive at a value. So capitalization to sales 0.75, 1.11. So you put all of them, and what are the sales? You get a value. So the value is 4.005. It is very simple. Same way, capitalization to assets. You take the ratio, multiply with assets, you get the value 2.88. Then capitalization to operating income, you take the operating income, multiply the capitalization rate, you get the value. So you put all 3 values together and hopefully take an average, right? Unless they specify, you take a simple average. If they specify, you can take a weighted average. So it comes to 4.178. So the stock is undervalued by 4.26% because 4.178 is higher than 4 million by about 4.26%. Very, very simple question. There is nothing complicated in this. Okay, this is question number 4. I just thought this is a warm-up. Okay, all questions in this chapter will not be like that. I'm just trying to show you how companies are valued. Now let us look at this. ABC is considering a new sales strategy that will be valid for next 4 years. They want to know the value of the new strategy. Following information relates to year which just ended. Sales, this is in rupees. It is simple rupees. So we'll take this as rupees. 20,000 gross margin, 40,000. SG&A is 2,000. PBT is 2,000. So tax is 30%. PAT is 1,400. Fixed assets is 8,000. Current assets is 4,000. Equity is 12,000. If it adopts a new strategy, sales will grow at 20% per year for 3 years. From 4th year, cash flow will be stabilized. Okay. Gross margin ratio, asset turnover ratio, capital structure, income tax rate, all of them will remain unchanged. Depreciation would be 10% of NFA from the beginning of the year. The company's target rate of return is 15%. Determine the incremental value due to adoption of the strategy. Incremental value means you have to first compute without the strategy and you have to compute with the strategy. So first, with the strategy. So turnover is going to grow at 20% for 3 years and then stabilized. So 3 years, it grows at 20, 20, 20, and then stable. Gross margin is at 20% of this value. So you compute at 20% of this value. Admin expenses, including depreciation, is 10%. So this is 10%. 10% of what? 10% of your revenue. Then you get PBT. PBT is subtraction of all these 3. Same thing they've given, right? Sales, gross margin, SG&A, and you get PBT. From PBT, you deduct 30% tax. So it is all these gross margin, admin expenses directly linked to revenue. Then you get a PAT number. From year 3, PAT is same as year 4 PAT. Then balance sheet. You have assets of how much? Fixed assets 8,000, current assets 4,000, equity 12,000. So fixed asset 8, current asset 4. And what did they say? They said as gross margin ratio, asset turnover ratio, and the capital structure and income tax will remain unchanged. So what is fixed assets as a percentage of turnover? 2.5 times. So it will remain 2.5 times always. So you multiply 2,000 or you divide 20,000 by 2.5, you get the assets. Same ratio will maintain always. So even in the last year, 34,560 by 2.5, you'll get 13,000, which is same for both year 3 and 4. Same way for current assets. Current assets are 20% of sales. Then total assets. Total assets is sum of current asset and fixed asset, which is equivalent to equity. Why? Because they themselves gave here. Fixed asset plus current assets match the equity value. So there is no debt, there are no other current liabilities or investments in any of those things. What is FCFF? FCFF is you have your PAT, whatever you arrived at, 1,400, 1,680, 2,016. You put all of that. Then you add change in working capital. Why do you have to do change in working capital? Because working capital increase is a cash outflow. Remember the FCFF formula, right? So increase in working capital is 800, then 970, then 1,200 something. So 800, 960, 1,100. And after that, because the sales is stabilizing and the current assets are stabilizing, there is no additional working capital. Then you subtract CapEx. How do you arrive at CapEx? CapEx, there is a working. Opening equity, see, equity, we have not equity, fixed assets, we have computed 8, 9,600, 11,550, 11,520, and so on. So you put those numbers, which is opening. right? Then 8, 9,600, 11, 520, correct? So for year one, 8,000 is opening. Then you have depreciation at 10%. How 10%? They themselves are mentioned here, no? Including depreciation, where is it? Depreciation will be 10% of NFA. So opening by 10%, you'll get 800, but closing, you've already arrived at as 9,600. So this is balancing figure. CapEx is balancing figure. So you work backwards and arrive at CapEx. So like that, every year you work backwards and arrive at CapEx. And in the last year that gets stabilized. And last year your CapEx and depreciation will be same. So then what happens? You subtract the CapEx and you add back the depreciation. Then you get the FCFF. This FCFF, you do present value of the FCFF. And this last year's FCFF, you do terminal value. For that, you get 16,128. So remember, P3 equal to D4 by KE minus G. Same logic applies here. Here there is no growth rate. So KE minus G means G is not there. So directly 15%. So P3. So this value is P3. So you are now adding that to the value of 3 and you're discounting everything, the terminal value and the FCFF. You take the 15% factor and discount, you arrive at a value which is 8,643. Hence the value of the business with new strategy is 8,643. Now what is the value of the business without this strategy? Without this strategy, first year, what is your FCFF? We've already arrived at first year FCF of 1,400. So you just directly discount that 1,400. 1,400. So 1,400 by 0.15, which is 9,333. So old strategy is 9,333. New strategy is 8,643. So don't go with new strategy. It's very, very simple. Okay. It is nothing complex. It is just that there is a lot of working. And this working is also not complicated. Working is simple. It is not like your IFM where there are so many complications. IFM will come to that chapter, but it is not like IFM where there are complications. It is simple. These are simple computations. Let us see if we can do one more problem. We'll have to wind up by 4:15. Throat is also aching. Right. 11. Number 11. Is it an easy one? If it's an easy one, we'll do. Otherwise, I think we'll wind up. Yeah, I think it's an easy one. Let us do it. Following information is available with respect to XYZ, which is expected to grow at a higher rate for 4 years, after which growth rate will stabilize at a lower level. So it will grow for 4 years, after which it is stable. Revenue, EBIT, CapEx, depreciation. Information for high growth and stable periods are given. High growth, 20, everything. Revenue, EBIT, CapEx, depreciation, risk-free rate. For everything, they've given variety of numbers. And they've also said CapEx and depreciation offset each other. For all-time working capital is 25% of revenue and corporate tax is 30%. What is the value of the firm? What is weighted average cost of capital? For high growth period, it is 10 into 1.15 into 6, right? So this is cost of equity. Cost of debt is 13. Tax rate is 30%. So cost of debt post-tax is 9.1. And they have given debt equity ratio. So the weights are 1:1. So 16.9 and 9.1 average is 13. For stable period, this is high growth period. Then stable period, you compute like that. Same way, 14, you use the same values given here. For you, the WACC comes to 12. Okay. So WACC is 12. They've asked value of the firm. Please note, value of the firm means FCFF. WACC is 13 and 12 for high growth and stable period. Now revenue, first year 2,000, then it grows for 20%, then it grows by 10% in the stable period. Same way, EBIT, it grows by 20%, then 10% and stable after that. Then tax rate is common, EBIT into 1 minus tax rate. So EBIT into 1 minus tax rate, just a minute. I'm sorry, excuse me. Working capital as a EBIT into 1 minus tax rate, you compute for year 1 onwards. Right? Because for year 0, base year, anyway, you don't discount. You're arriving at the value in the base year. You compute EBIT into 1 minus tax rate, then you compute working capital as a percentage of sales because they said it is going to be stable. Then you compute what is the increase in working capital. Now you already have a depreciation number. Where is the depreciation number? 200. And they said depreciation also going to grow by 20% per year and then stable. So depreciation, you keep growing it by 2020 and then it becomes stable. Depreciation, CapEx, both of them are same. So you need not bother about that. Now, what is FCFF? You take EBIT into 1 minus tax rate from here. You add back depreciation for the 4 years of high growth period. Then you subtract capex. You are doing both of them because both of them are different. Whereas from last year onwards, they both are same. So you're not bothering about them. Increase in working capital, you take the actual increase in working capital, which you've computed. Then you get FCFF. And discount rate for the first 4 years, you use 13%. For the last year, you use 12%. So you present value of all the first 4 explicit period, which is the high growth period, is 217. Then you add the 4th year, which is terminal value for the last year. So last year is 375 is the FCFF divided by 12 minus 10. Why is 12 minus 10? 12 is your weighted average cost of capital and 10 is your growth rate. So you get 18,000. So present value of the terminal value, you have to bring it forward to year 0. So that comes to 11,000. So the total value of the firm is 217 plus 11,500, which is 11,727. So most of the value of the firm is in its terminal value and is not in the explicit period. Right? First 3 years contribute very less, or first 4 years rather, and the period after 4 years contributes a very large amount. Right. So I think we have finished 3 questions. There are 1, 2, 3, 4, 5, 6, 7, 8. I think 7 or 8 questions are there. We will continue them in the next session. We'll have the next session sometime next week. I'll communicate the dates. Most likely, we'll finish everything in the next session, so that you're prepared for exams. I will not do it too close to the exams. I'll do it probably as soon as possible next week. Okay. So fair enough. That's the session for the day. We'll wind up. In case you have any doubts, you have any feedback, do let us know. If you want to share with us something, if you want to share this with your friends, let us know. And, we shall help you out. Okay. Fair enough. So that concludes session for the day. All the very best. Catch you again all over again when we do the next session.